The committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time. This hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on the conduct of monetary policy and the state of the economy. I now recognize myself for 3 minutes to give an opening statement. Last week, this committee began a series of hearings examining the Dodd-Frank Act on its 5th anniversary, an act which vastly expanded the powers and reach of the Federal Reserve beyond its traditional monetary policy role in historically unprecedented ways. The evidence continues to mount that since the passage of Dodd-Frank, our nation is less stable, less prosperous, and less free. We continue to be mired in lackluster, halting economic growth. Middle-income paychecks are nearly $12,000 less compared to the average post-war recovery. And as the ranking member, Ms. Waters, told us just a few months ago, quote, "The brutal truth is millions continue to teeter on the brink of poverty and collapse." One way our economy could be healthier is for the Federal Reserve to be more predictable in the conduct of monetary policy. During periods of expanded economic growth, like the Great Moderation of 1987 to 2003, the Fed followed a more clearly communicated and understandable and predictable convention or rule. America prospered. Today we're left with so-called forward guidance, which unfortunately remains somewhat amorphous, opaque, and improvisational. Too often this leads to investors and consumers being lost in a rather hazy mist as they attempt to plan their economic futures and create a healthier economy for themselves and for us all. As one former Fed president has written, quote, "Monetary policy uncertainty creates inefficiency in the capital market. The FOMC gives lip service to policy predictability, but its statements are vague. The FOMC preaches that policy is data dependent, but will not tell us what data and how." Following a monetary policy convention or rule of the Fed's own choosing, with the power to amend it or deviate from it at the Fed's own choosing, in no way interferes with the Fed's monetary policy independence. Accountability and independence are not mutually exclusive concepts. Next, we in Congress would be grossly negligent if we did not engage in greater oversight of the Federal Reserve System. Again, Dodd-Frank confers sweeping new powers on the Fed to regulate and control virtually every corner of the financial services sector of our economy, completely separate and apart from its traditional monetary policy role. Yet too often, the Fed appears to shield these activities from public view, improperly cloaking them behind monetary policy independence. Second, the Fed has now employed historically unprecedented methods, from intervening to prop up select credit markets, to paying interest on excess reserves, to keeping interest rates near zero for almost 7 years. By doing so, the Fed has certainly blurred the lines between fiscal and monetary policy. Finally, the Fed has recently crossed the line by willfully ignoring a lawful congressional subpoena for documents. This is inexcusable and unsupported by legal precedent. It cannot be allowed to stand. The Fed's refusal to cooperate in a congressional investigation threatens both its reputation and its credibility. The Fed is not above the law. It's a very serious matter and must be resolved. Chair now yields to the ranking member 3 minutes for an opening statement.
Thank you, Mr. Chairman, and welcome back, Chair Yellen. I'm pleased you're here this month as we commemorate the 5-year anniversary of the enactment of the Dodd-Frank Wall Street Reform Act. Dodd-Frank was signed into law just as we had emerged from the worst economic collapse in a generation, one which destroyed nearly $16 trillion in household wealth and 9 million jobs, displaced 11 million Americans from their homes, and doubled the unemployment rate. But since those dark days, we've seen improvement. Dodd-Frank made significant progress, correcting the practices that helped lead us to the crisis. It has delivered billions to victimized consumers, brought greater transparency to the once opaque banking practices that have caused the crisis, and put in place clear rules of the road that foster stability in our financial system. That stability, along with the help of extraordinary monetary policy accommodation, has led to growth, including the creation of nearly 13 million private sector jobs, unemployment falling to its lowest rate since September 2008, a recovering housing market, and significant increases in 401k balances and the S&P 500. But these improvements do not paint a picture of an economy that has fully recovered. The gap between communities of color and women versus their white male counterpart remains dramatic. A lackluster first quarter and a strong dollar, coupled with economic instability and slowing growth abroad, have sapped momentum for job creation and economic expansion here at home. As such, I hope the Board of Governors will continue its slow and cautious approach to raising interest rates. Chair Yellen, as you know, raising interest rates does not in itself create a strong economy. It is a strong economy that must be the impetus for raising rates. With inflation continuing to hover near zero and numerous indicators of slack in the labor market, it is my hope that the Federal Reserve will fully consider the impact of any potential interest rate increase on the middle class and those communities that have yet to benefit from the economic recovery. So I thank you again, Chair Yellen, and I look forward to your testimony here today, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of our Monetary Policy and Trade Subcommittee, for 2 minutes.
Chair Yellen, up over here. Sorry, it feels like you're kind of down closer to the Botanic Garden than you are here in Rayburn, our new configuration. But welcome, good to see you again, and thank you for honoring my request to meet together last month. Today's hearing provides us with another opportunity to examine how the Federal Reserve conducts monetary policy and why the development of these policies are in desperate need of transparency, I believe. Needless to say, the Fed's recent high degree of discretion and its lack of transparency in how it conducts monetary policy suggests that reforms are needed. I've continued to encourage the Federal Reserve, as you well know from that conversation, to adopt a rules-based approach to monetary policy and to communicate that rule to the public. The Fed must be accountable to the people's representatives as well as, more importantly, to the hardworking taxpayers themselves. Last Congress, Professor Alan Meltzer of Carnegie Mellon University testified that over the first 100 years of the Federal Reserve's history, monetary policy has operated more effectively if it follows simple and clearly understood rules. And I quote from him, "There are only 2 periods in Federal Reserve history where they came close to operating under a rule. That happened to be the best 2 periods in Fed history, in 1923 to 1928 and in 1985 to 2003. In the first case, they operated under some form of the gold standard. In the second, under the Taylor rule, more or less, not slavishly, but more or less. And those were the 2 and the only 2 periods in Federal history that have low inflation, relatively stable growth, small recessions, and quick recoveries." That's Alan Meltzer. Well, Chair Yellen, I ask that you work with me and this committee to develop a foundation for a rules-based monetary policy that will properly, not slavishly, to borrow a phrase, constrain the Fed's discretion without sacrificing the proper independence the Fed has, while also allowing the Fed to be more transparent in formulating and communicating monetary policy to not only market participants but also to the American people. So thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, for 2 minutes, ranking member of the Monetary Policy and Trade Subcommittee.
Well, thank you so much, Mr. Chairman. And Madam Chairwoman, I am so happy to welcome you back, and I look forward to your testimony, to the Q&A period, and I think this committee will benefit from your strong background in economics. We're, of course, in the midst of a strong 2-year job growth in 15 years, adding 5.6 million jobs, but I have some concerns. You talk about slack in the labor market, and it seems to me that that slack is disproportionately borne by African Americans and Latinos. And so this brings me to the critical importance of the full employment part of your dual mandate. And so while we're plotting upwards, there are still many storm clouds. I want to see growth which will create jobs and decrease the national debt. Now, I cringe at the austerity policies of this Republican Congress because I think it works at cross purposes with your pro-growth policies, and I want to hear you talk about that. Your predecessor, Ben Bernanke, came to Congress and told us that the sequester and the shutdown were examples of counterproductivity. We want to get this slack, as you call it, out of the labor market, but Congress needs to embrace growth policies that will help working people. Wall Street is doing just fine, but we need to invest in education and infrastructure, increase the minimum wage so that we can get more consumers spending money. I read in your testimony here that the U.S. exports are slumping, but yet this committee has refused to reauthorize the Export-Import Bank. These are unforced errors. And I thank you, and I look forward to hearing your testimony, and I yield back the balance of my time.
The gentlelady yields back. Today we welcome the testimony of the Honorable Janet Yellen. Chair Yellen has previously testified before our committee, so I believe she needs no further introduction. At the request of the Chair, I wish to inform all members I intend to adjourn the hearing at 1 p.m. this afternoon. Chair Yellen, without objection, your written statement will be made a part of the record. Chair Yellen, you are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you for being here.
Thank you. Chairman Henserling, Ranking Member Waters, and members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will discuss the current economic situation and outlook before turning to monetary policy. Since my appearance before this committee in February, the economy has made further progress toward the Federal Reserve's objective of maximum employment, while inflation has continued to run below the level that the FOMC judges to be most consistent over the longer run with the Federal Reserve's statutory mandate to promote maximum employment and price stability. In the labor market, the unemployment rate now stands at 5.3%, slightly below its level at the end of last year and down more than 4.5 percentage points from its 10% peak in late 2009. Meanwhile, monthly gains in non-farm payroll employment averaged about 210,000 over the first half of this year, somewhat less than the robust 260,000 average seen in 2014, but still sufficient to bring the total increase in employment since its trough to more than 12 million jobs. Other measures of job market health are also trending in the right direction, with noticeable declines over the past year in the number of people suffering long-term unemployment and in the numbers working part-time who would prefer full-time employment. However, these measures, as well as the unemployment rate, continue to indicate that there is still some slack in labor markets. For example, too many people are not searching for a job, but would likely do so if the labor market was stronger. And although there are tentative signs that wage growth has picked up, it continues to be relatively subdued, consistent with other indicators of slack. Thus, while labor market conditions have improved substantially, they are, in the FOMC's judgment, not yet consistent with maximum employment. Even as the labor market was improving, domestic spending and production softened notably during the first half of this year. Real GDP is now estimated to have been little changed in the first quarter, after having risen at an average annual rate of 3.5% over the second half of last year. And industrial production has declined a bit on balance since the turn of the year. While these developments bear watching, some of this sluggishness seems to be the result of transitory factors, including unusually severe winter weather, labor disruptions at West Coast ports, and statistical noise. The available data suggest a moderate pace of GDP growth in the second quarter as these influences dissipate. Notably, consumer spending has picked up and sales of motor vehicles in May and June were strong, suggesting that many households have both the wherewithal and the confidence to purchase big-ticket items. In addition, home building has picked up somewhat lately, although the demand for housing is still being restrained by limited availability of mortgage loans to many potential home buyers. Business investment has been soft this year, partly reflecting the plunge in oil drilling, and net exports are being held down by weak economic growth in several of our major trading partners and the appreciation of the dollar. Looking forward, prospects are favorable for further improvement in the U.S. labor market and the economy more broadly. Low oil prices and ongoing employment gains should continue to bolster consumer spending. Financial conditions generally remain supportive of growth, and the highly accommodative monetary policies abroad should work to strengthen global growth. In addition, some of the headwinds restraining economic growth, including the effects of dollar appreciation on net exports and the effect of lower oil prices on capital spending, should diminish over time. As a result, the FOMC expects U.S. GDP growth to strengthen over the remainder of this year and the unemployment rate to decline gradually. As always, however, there are some uncertainties in the economic outlook. Foreign developments in particular pose some risks to U.S. growth. Most notably, although the recovery in the euro area appears to have gained a firmer footing, the situation in Greece remains difficult. And China continues to grapple with the challenges posed by high debt, weak property markets, and volatile financial conditions. But economic growth abroad could also pick up more quickly than observers generally anticipate, providing additional support for U.S. economic activity. The U.S. economy also might snap back more quickly as the transitory influences holding down first-half growth fade and the boost to consumer spending from oil prices shows through more definitively. As I noted earlier, inflation continues to run below the committee's 2% objective, with the Personal Consumption Expenditures, or PCE, price index up only 0.25% over the 12 months ending in May, and the core index, which excludes the volatile food and energy components, up only 1.25% over the same period. To a significant extent, the recent low readings on total PCE inflation reflect influences that are likely to be transitory, particularly the earlier steep declines in oil prices and in the prices of non-energy imported goods. Indeed, energy prices appear to have stabilized recently. Although monthly inflation readings have firmed lately, the 12-month change in the PCE price index is likely to remain near its recent low level in the near term. My colleagues and I continue to expect that as the effects of these transitory factors dissipate and as the labor market improves further, inflation will move gradually back toward our 2% objective over the medium term. Market-based measures of inflation compensation remain low, although they have risen some from their levels earlier this year, and survey-based measures of longer-term inflation expectations have remained stable. The committee will continue to monitor inflation developments carefully. Regarding monetary policy, the FOMC conducts policy to promote maximum employment and price stability as required by our statutory mandate from the Congress. Given the economic situation that I just described, the committee has judged that a high degree of monetary policy accommodation remains appropriate. Consistent with that assessment, we have continued to maintain the target range for the federal funds rate at 0 to 0.25% and have kept the Federal Reserve's holdings of longer-term securities at their current elevated level to help maintain accommodative financial conditions. In its most recent statement, the FOMC again noted that it judged it would be appropriate to raise the target range for the federal funds rate when it has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. The committee will determine the timing of the initial increase in the federal funds rate on a meeting-by-meeting basis, depending on its assessment of realized and expected progress toward its objectives of maximum employment and 2% inflation. If the economy evolves as we expect, economic conditions likely would make it appropriate at some point this year to raise the federal funds rate target, thereby beginning to normalize the stance of monetary policy. Indeed, most participants in June projected that an increase in the federal funds target range would likely become appropriate before year end. But let me emphasize again that these are projections based on the anticipated path of the economy, not statements of intent to raise rates at any particular time. A decision by the committee to raise its target range for the federal funds rate will signal how much progress the economy has made in healing from the trauma of the financial crisis. That said, the importance of the initial step to raise the federal funds rate target should not be overemphasized. What matters for financial conditions in the broader economy is the entire expected path of interest rates, not any particular move, including the initial increase in the federal funds rate. Indeed, the stance of monetary policy will likely remain highly accommodative for quite some time after the first increase in the federal funds rate in order to support continued progress toward our objectives of maximum employment and 2% inflation. In the projections prepared for our June meeting, most FOMC participants anticipated that economic conditions would evolve over time in a way that will warrant gradual increases in the federal funds rate as the headwinds that still restrain real activity continue to diminish and inflation rises. Of course, if the expansion proves to be more vigorous than currently anticipated and inflation moves higher than expected, then the appropriate path would likely follow a higher and steeper trajectory. Conversely, if conditions were to prove weaker, then the appropriate trajectory would be lower and less steep than currently projected. As always, we will regularly reassess what level of the federal funds rate is consistent with achieving and maintaining the committee's dual mandate. I'd also like to note that the Federal Reserve has continued to refine its operational plans pertaining to the deployment of our various policy tools when the committee judges it appropriate to begin normalizing the stance of policy. Last fall, the committee issued a detailed statement concerning its plans for policy normalization, and over the past few months, we have announced a number of additional details regarding the approach the committee intends to use when it decides to raise the target for the federal funds rate. These statements pertaining to policy normalization constitute recent examples of the many steps the Federal Reserve has taken over the years to improve our public communications concerning monetary policy. As this committee well knows, the board has for many years delivered an extensive report on monetary policy and economic developments at semi-annual hearings such as this one. And the FOMC has long announced its monetary policy decisions by issuing statements shortly after its meetings, followed by minutes with a full account of policy discussions, and, with an appropriate lag, complete meeting transcripts. Innovations in recent years have included quarterly press conferences and the quarterly release of FOMC participants' projections for economic growth, unemployment, inflation, and the appropriate path for the committee's interest rate target. In addition, the committee adopted a statement in 2012 concerning its longer-run goals and monetary policy strategy that included a specific 2% longer-run objective for inflation and a commitment to follow a balanced approach in pursuing our mandated goals. Transparency concerning the Federal Reserve's conduct of monetary policy is desirable because better public understanding enhances the effectiveness of policy. More important, however, is that transparent communications reflect the Federal Reserve's commitment to accountability within our democratic system of government. Our various communications tools are important means of implementing monetary policy and have many technical elements. Each step forward in our communications practices has been taken with the goal of enhancing the effectiveness of monetary policy and avoiding unintended consequences. Effective communication is also crucial to ensuring that the Federal Reserve remains accountable, but measures that affect the ability of policymakers to make decisions about monetary policy, free of short-term political pressure in the name of transparency, should be avoided. The Federal Reserve ranks among the most transparent of central banks. We publish a summary of our balance sheet every week. Our financial statements are audited annually by an outside auditor and made public. Every security we hold is listed on the website of the Federal Reserve Bank of New York, and in conformance with the Dodd-Frank Act, transactions-level data on all of our lending, including the identity of borrowers and the amounts borrowed, are published with a 2-year lag. Efforts to further increase transparency, no matter how well-intentioned, must avoid unintended consequences that could undermine the Federal Reserve's ability to make monetary policy in the long-run best interest of American families and businesses. In sum, since the February 2015 Monetary Policy Report, we have seen, despite the soft patch in economic activity in the first quarter, that the labor market has continued to show progress toward our objective of maximum employment. Inflation has continued to run below our longer-run objective, but we believe transitory factors have played a major role. We continue to anticipate that it will be appropriate to raise the target range for the federal funds rate when the committee has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. As always, the Federal Reserve remains committed to employing its tools to best promote the attainment of its dual mandate. Thank you. I'd be pleased to take your questions.
Thank you, Chair Yellen. The Chair recognizes himself for 5 minutes for questions. Chair Yellen, I hate to take up time to ask this, but it's an important matter. As we well know, Dodd-Frank vastly expanded the non-monetary policy role of the Fed. Through no fault of your own, there has not been a vice chair for supervision appointed. My counterpart, Chairman Shelby in the Senate, has requested that you come on a semi-annual basis until such a time as the President deigns to fill that position and testify on the macroprudential regulatory role of the Fed. Your written response to our request, to put it politely, was not responsive. So will you voluntarily honor our request? And if the answer is yes, I'll take yes for an answer. And if the answer is no, I'll give you a brief moment to explain.
I certainly stand ready to respond to requests of this committee for me to testify.
Thank you. I'll take yes for an answer, and we will certainly issue those invitations. I want to discuss with you, Chair Yellen, the Exigent Powers 13.3 clause. There seems to be a growing consensus on both sides of the aisle, among the right and the left, that Dodd-Frank, notwithstanding its intentions to constrain 13.3, did not hit the mark. And in fact, Senator Elizabeth Warren has been rather outspoken on the matter and has actually introduced bipartisan legislation on the Senate side in this regard. Setting aside the arguments of whether or not AIG bailout specifically was a good thing or a bad thing, Post-Dodd-Frank, is it your interpretation that the Fed retains the power to do a similar bailout of AIG, where counterparties and creditors could receive 100 cents on the dollar, including foreign entities?
So let me start by saying that the role of lender of last resort is a critical responsibility that central banks fulfill around the world, and it's why the Federal Reserve was created. I do believe this is a very important power. We need to address liquidity and credit pressures in times when there is unusual financial stress. However, Congress did amend Section 13.3 in Dodd-Frank to allow the Federal Reserve to extend emergency credit to the financial system only through facilities that have broad-based eligibility.
Chair Yellen,
the answer is no, that we could not use those powers to address the needs of a single firm like the AIG situation.
But several other firms, if an AIG bailout was made available to a specific firm, as long as it was made to multiple firms, there's still nothing preventing the Fed from ensuring counterparties and creditors get 100 cents on the dollar. Is that correct? Or do you disagree with that statement?
Well, Section 13.3 was amended to state specifically that a broad-based...
I'm familiar with the statute. I'm just trying to figure out if you believe it constrains creditors getting 100 cents on the dollar.
Well, if we have failing financial firms, we would not be able to put in place a broad-based facility that was intended to rescue those firms.
If I could, Chair, let me ask you this.
It's not allowed by Dodd-Frank.
Let me ask you this question. There obviously is a difference of opinion there. Federal Reserve Bank President Jeffrey Lacker recently gave a speech dealing with 13.3 and dealing with moral hazard, and I agree with you, the lender of last resort function is important, but so is moral hazard in creating greater systemic risk. President Lacker said, quote, "A final step may be required before financial stability can be assured. This would mean repealing the Federal Reserve's remaining emergency lending powers and further restraining the Fed's ability to lend to failing institutions." Are you aware of President Lacker's views on this topic?
I am aware of his views, but I disagree with him.
When do you expect...
Dodd-Frank has been amended to limit our powers, as I mentioned, to bail out a single firm or a failing firm or an insolvent
Chair Yellen, when do you
borrower.
expect that we will have the final rule on 13.3? Because we know there were 800 pages devoted to helping define proprietary trading in the Volcker rule, but we see no such effort in defining the concepts of insolvent and broad-based, and presently are seeing no real constraint to your 13.3 ability. So when would we expect to see that final rule?
Well, we put out a draft rule.
I'm aware of that.
And we received a number of comments, and we're working hard to come out with a revision, and I expect that it will certainly be out in the fall.
Okay, thank you. Chair's time has expired. The Chair now recognizes the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chair Yellen, this morning I woke up to yet another story about discrimination against minorities. It seems Honda has been caught charging higher interest rates, I guess, on their loans to African Americans and Latinos. When I hear those kinds of stories, and I'm reminded about the predatory lending practices that took place in this country, 2008, et cetera, and how these predatory practices were targeted to minority communities, and minorities were charged higher interest rates, and when they compared the income and the credit that blacks and minorities, their credit records to the credit records of whites. They could be the same, but they were paying more interest rates on many of these predatory products. And when I look at the loss of wealth in these communities based on the subprime lending, I cannot help but wonder, when is this going to stop? When is it going to stop? And while we have you here today, and we're talking about monetary policy, and we're talking about interest rates, qualitative easing, et cetera, I don't know how much you can do to deal with this inequality. I don't know there's anything that perhaps you can do that deals with discrimination, that deals with racism, that deals with income inequality, that deals with the problems that causes this great wealth gap that's so big now that it will never be closed. We hear a lot of talk about income inequality and the wealth gap, et cetera, and we look at the high unemployment rates in the African American and Latino communities, and sometimes you just think, you know, despite the struggle, despite all of the work, despite the challenges, some of this stuff just will never go away in this country. So I guess I'm asking you, you know, because, you know, you have the responsibility for some of what goes on in this economy relative to some of these issues. What can you do? I mean, what can you do about Honda? What can you do about the banks and the predatory practices that continue to gouge, you know, Latinos and African Americans and target these products to our communities? What do you say about all of this?
So let me start by saying that the practices you described and the trend toward rising inequality, the impact that it has on African Americans and disadvantaged groups is something that greatly concerns me, and I think is of tremendous concern to all Americans. In terms of what we can do when it comes to lending, we're responsible for supervision of financial institutions to make sure that they adhere to fair lending practices, and we test regularly in our consumer compliance exams to make sure that the firms that we supervise are abiding by Congress's rules pertaining to the Equal Credit Opportunity Act, to make sure that there are not unfair credit practices that are being directed toward minorities or toward any Americans. So that is an important goal. We, of course, work to make sure that the banks we supervise meet their CRA responsibilities, which I think has been of benefit to low and moderate income communities, and more broadly, in terms of our monetary policy responsibilities, maximum employment along with price stability are the two major goals that Congress has assigned to us. The downturn that we experienced after the financial crisis, where unemployment rose to over 10%, was particularly punishing to African Americans and to lower skilled workers more broadly, and a strong economy, getting the economy recovering, trying to get it back to maximum employment, lowering the unemployment rate. Traditionally, African Americans and other minorities have had higher unemployment rates. We don't have the tools to be able to address the structure of unemployment, but across groups. But a strong economy generally, I think, really does tend to be beneficial to all Americans. So that's what we're working toward. And there are other policies that I think Congress could consider that would address these issues.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. And Chair Yellen, I think we share a respect for rules-based monetary policy. As you put it when you served on the Fed board in the mid-90s, the Taylor rule is, quote, what sensible central banks do. And it looks like we're in pretty good company. Dr. Charles Plosser, immediate past president of the Federal Reserve Bank of Philadelphia, expressed support for a rules-based framework by setting monetary policy, and, quote, him, one of the most important ways to support credibility and thus the effectiveness of forward guidance is to practice it as part of a systematic policy framework. I believe that indicating how the evolution of key economic variables systematically shapes current and future policy decisions is critical to such a policy framework. Testimony before this committee in December of 2013, Dr. Douglas Holtz-Aiken, former director of the Congressional Budget Office, also endorsed a rules-based monetary policy, saying, certainly I would like to see a far more of a rules-based approach by the Federal Reserve that doesn't rule out discretion, because they can pick the rule that they want to operate. But if they can provide it to the Congress and the American people will know what they are up to, and they themselves have said forward guidance is critical. We need to know what they are going to do. Rules provide that, close quote. So I'm curious when you and your colleagues at the Fed will adopt a rules-based policy.
So you used the term systematic policy, and I want to say that I strongly endorse, and the FOMC strongly endorses, following a systematic policy. And during my term as vice chair and as chair, I have tried to promote a systematic monetary policy, and I believe that we do follow a systematic monetary policy.
But not a rule that you're willing to share, correct?
Not a simple rule based on two variables, but let me point you first in the monetary policy report. On the second page of the report, we have a clear statement of our longer-run goals in monetary policy strategy. Any systematic policy has to begin by articulating what the goals are very clearly and the strategy that will be followed, and that's what we do there.
But you do agree that a rule-based policy is a better way to go?
I don't agree that a rules-based policy is a better way to go. There is not a single central bank in the world that follows a rule that would rely on only two variables.
So, well,
what we do is take into account a wealth of information informing our judgments about the economic outlook.
Sure.
And the way we make policy systematic is we provide, and you can see this in Section 3, in Part 3 of the Monetary Policy Report, each individual, each participant writes down their own forecast for the economy and the appropriate policy that goes along with that. And from that, you can get a clear sense of how we expect to conduct policy if the economy evolves in line with our forecast.
I'm not convinced that is clear, because others in the market don't believe that's clear. Other economists don't believe that is clear. And we're not trying to handcuff you, but we are asking that you write a rule within descriptive parameters to use as a reference point. Purely use it as a reference point. And I know one of the things that you've expressed here is, well, you know, we could find ourselves, if we had a rule, we may find ourselves in negative interest rates. Well, simply solve that by writing a rule that says once we do that, we're going to go to 0 and no lower, or maybe 0.25, as you have indicated. We won't call it the Taylor rule, we'll call it the Yellen rule. We can have some of those things that are going to give some predictability, and I think whether it's Douglas Holtz-Aiken or others that have been within the Federal Bank Reserve have said that predictability and that transparency is the way to go. So I know you know that we have a good discussion draft floating around that has some of that information in there. And so just so I'm clear, you don't believe that there is a time that will be right to again go towards a rule-based policy?
I think we need a systematic policy, but I would strongly resist agreeing to follow any rule where the stance of monetary policy depends on only the current readings of two economic variables, which is what your reference rule relies on.
That's what the reference rule does, but it doesn't say that's the rule you have to follow. And we've got a lot of confusion out there. The IMF is saying you shouldn't be raising interest rates. The Bank for International Settlements, which is the central bank of central banks, as you well know, Claudio Borio had said lower rates beget lower rates. And we've got a lot of confusion out there as to the direction we're going, and that's what we're asking for is clarity. Thank you, Mr. Chairman.
I strongly believe in a systematic policy.
Time of the gentleman has expired. The Chair now recognizes the gentlelady from Wisconsin, Ms. Moore, Ranking Member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Madam Chair, and my colleague, the Chair of the Monetary Policy and Trade Subcommittee, has been discussing with you the Taylor rule, and so I'd like to pursue that a little bit more. The IMF is warning that if Greece leaves the Eurozone, that it might slow growth internationally and impact the U.S. Much harder than expected. I guess I'd like you to just sort of speculate about how, if you were handcuffed, to borrow the terms used here earlier, the Taylor rule, how would that impede your response to such a crisis?
The Taylor rule would tell us that the current setting of monetary policy should depend on only two variables, the current level of real GDP, or the output gap, and the current level of inflation. So it obviously wouldn't take into account in any way our judgments about likely growth in the global economy, how we expected that the European economy would be affected, or global financial markets, by such developments. So in that sense, it really restricts, any simple rule restricts the setting of monetary policy to a very short list of variables, and typically their current values. That's one of the reasons. I mean, we spend a great deal of time, and the forecast that we include in our monetary policy report that the participants write down, we present to the public every 3 months, incorporate all of the kind of information, what we think is going to happen in the global economy and other economic developments. Those factor into our economic forecasts and our view as to the appropriate role of policy. We are providing a great deal of information to the public by providing these participants' forecasts, because participants are telling the public how, in light of their economic forecast, concretely with numbers, they think monetary policy should be set. So that is information about the so-called reaction function, namely the relationship between the economy and monetary policy, that is incorporated in something like the Taylor rule.
Thank you so much. Can you provide us with a quick update of the Fed's implementation of the so-called Collins fix governing insurance capital standards?
Well, we appreciate Congress's passing the Collins fix. And in light of that, we have a great deal of flexibility now to design capital standards that we think will be appropriate for the firms that we supervise, including the insurance-based savings and loan holding companies and the insurance SIFIs. And we're working hard. We will put in the public domain either orders or a proposed rule when we've figured that out.
Thank you so much. We're the 5-year look back of Dodd-Frank. Our colleagues again say that we've enshrined too big to fail. Wonder if you could just set the record straight about whether or not Dodd-Frank enshrined too big to fail.
Well, I don't believe that Dodd-Frank enshrined too big to fail. First of all, it directed us to increase the safety and soundness of financial institutions, and particularly those that are most systemic. So it gave us tools to raise capital and liquidity to impose capital surcharges on those firms that we deem most systemic, to use stress testing as a methodology to make these firms much less likely to fail, and the amount of capital and liquidity has increased massively since the crisis. In addition, Dodd-Frank gave us both Title II orderly liquidation authority, which would be a new tool to resolve a
I got 10
systemic
seconds
firm,
left, so
and Title I.
I think you've covered it. Back to my idea about the labor market. Do you think ending the sequester and raising the minimum wage would be good strategies for getting our labor markets together?
Well, this is, I think, matters for Congress to debate.
I knew you'd say that, so I
The
said
time of the
that.
gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of the Capital Markets Subcommittee.
Good morning, and over here, thanks. Thanks, Chair. So in front of me, last night, I read through what is called the Joint Staff Report, the U.S. Treasury Market on October 15th, 2014. It's the staff report that looked at the what happened in the markets back on mid-October. A, are you familiar with that report? And B, do you adopt that report, even though I see the name of it is the Joint Staff Report? Just as a technical matter, does that mean that this is just staff's opinion, or is this also your opinion, just so I understand that?
Well, I'm certainly aware of its intensive staff work by staff in a number of agencies,
But you
but I
adopt-
think it's a
but you
good
as-
report. I certainly support the report.
Okay, great. I assume so. So I thought there was one seminal question, but I guess maybe there's two seminal questions. When I read that, and I also read your testimony and the addendums to your testimony this morning, which only came in this morning, first of all, is there a problem? And then secondly, what was the cause? I thought that we would all have concluded that there was a problem, but that's not clear from looking at the addendum to your report that came out as far as your testimony, where it says at the bottom, despite the increased market discussions and talking about the disruptions, a variety of metrics of liquidity in the nominal Treasury markets do not indicate notable deteriorations. And then you go on to say elsewhere that there really wasn't much problems in the liquidity of the market. And you give some talk about that. So I think there's a problem. Other people think there's a problem. We had hearings on this, and Rick Ketchum, the CEO and chairman of FINRA, told this committee, there have been dramatic changes with respect to the fixed income market in recent years. So the question is Rick Ketchum right, that there's been dramatic changes to it and there's a problem in the marketplace there, or is your staff and you right, that there is not a problem in the liquidity and the deterioration in that marketplace? Let's find out whether there's a problem, first of all.
So I think it's not clear what's happening in these markets and
True,
what
but is
what
there
is causing
is there a
what.
problem, though, before we
Well,
get to
the report that you mentioned that was just released looked at a 12-minute window carefully in which...
But overall, Ketchum is saying that there has been a deterioration and that there is a problem overall. He's saying there is a problem. Other panelists have said there is a problem over on the market. You're saying, and your staff is saying, there isn't any.
It's not clear whether there is or there is not
Okay,
a problem.
that's
By some metrics,
Right.
liquidity looks adequate. By bid-ask spreads
I
and
think that's-
trading volumes, we
let me just interrupt,
don't
because
see
we
a
only have two-
problem, but there are metrics that suggest there is a problem.
So-
So this is something we need to study. We need to study further.
So you studied it so far. You've had an 80-page report that looked at it, and I find it troubling that it really doesn't come to much conclusion. What I was looking for was the second seminal question that the chair and I've asked Lou and others. What was the cause of this? And this still fails to come up with any particular explanation. It runs through about a half a dozen explanations of saying these are not the problem. One of them that it does say, one of them that it does refer to, it says the growth in, or some of them it says the growth in electronic trading, competitive pressures, other factors, and regulation. That word regulation only appears twice, but your staff actually says regulation is an indicator to the changes in the volatility and the liquidity on that marketplace. So it says that regulation is part of the problem, right?
Well, we just don't have a conclusion about what happened in the Treasury market at this point.
but you don't have
Regulation could have contributed in some way to this. but there are many other things going on as well.
But it doesn't say that in your addendum at all. It says that in the staff report. Nowhere did I see that it looks to regulation as being the factor. It looks at all other factors that are talked about here, whether it's the size, order trade size, whether it's the electronic trades, whether it's competitive pressures. It doesn't say that in here. We never heard that from, we can never get that answer from Secretary Liu or anyone else from the administration. So are you saying today that, yes, regulations such as Volcker, Basel, capital requirements, they are potential problems in this area?
There are things to look at. We have no evidence that those things that you mentioned are problems.
Well,
during this window,
so let me ask you this. Let me ask you this.
broker-dealers
May I ask you a
continue
question?
to...
Did you direct your staff to look in to see whether that was a potentiality? Because they don't say it once in their report that they looked into regulation as a causation. They looked at all the metric data on these other areas. Did you direct them to look at that as a factor, and will you in the future?
We asked them to take a look at what caused this very unusual movement in Treasury yields.
They didn't.
And to study what possible causes of it were, and they were unable to find any single cause. And they pointed to a number of factors that could have been at play, and it needs further study, and it's right for regulation to be on that list of things that we look at. But there's no evidence
The
at this
time
point
of
that
the
was
gentleman has
causal.
expired. The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of the Capital Markets Subcommittee.
Welcome, Chair Yellen. I know that some of my colleagues have been critical of your performance, but I, for one, think you have done a tremendous job, and I want to publicly thank you. You have been very responsive to Congress, and you have also managed to wind down the quantitative easing program very smoothly and right on schedule without causing any major disruptions in the financial markets. So thank you. And I'd like to ask you some questions about monetary policy. In your testimony today, you said that foreign developments, including the turmoil in Greece and China, in your words, pose some risk to United States growth. Has the turmoil in China and Greece changed your view about the appropriate timing for the first interest rate hike?
So we look at international developments very carefully in developing our forecast. We've been tracking closely developments in Greece and China and other parts of the world. The issues that exist are not new. For example, the committee in June was aware of these developments. And in June, when the participants wrote down their views of the economy and appropriate policy, taking into account these developments and the risks they posed, they still thought that the overall risk to the U.S. economic outlook were balanced, and they judged that it would likely be appropriate sometime this year to begin raising our target range for the federal funds rate. Of course, we continue to watch these developments, these global developments unfold, and we will in the coming months. Were we to judge that these developments did create substantial risks or were changing the outlook in some notable way, then a change in the outlook is something that would affect monetary policy. As we've said all along, we have no judgment at this point about the appropriate date to raise the federal funds rate. Our judgment about that will depend on unfolding economic developments and how they affect our forecasts.
You stressed in your testimony that the pace of rate increases is more important than the timing of the first rate hike. And many economists, including the IMF, have argued that the Fed should wait longer to start raising rates, possibly waiting until next year, but should then follow a slightly steeper path of subsequent rate increases. So my question is if the Fed waits longer than currently forecast to start raising rates, will that mean a steeper path of rate increases?
Well, if we wait longer, it certainly could mean that when we begin to raise rates, we might have to do so more rapidly. So an advantage to beginning a little bit earlier is that we might have a more gradual path of rate increases. As I indicated, the entire path of rate increases does matter. There are many reasons why the committee judges in effect that an appropriate path of rate increases is likely to be gradual. But given that we have been at zero for over 6 years, it's been a long time since we've raised rates. Doing so when we finally begin in a deliberate and gradual way, looking at what the impact of those decisions are on the economy, strikes me as a prudent approach to take.
Okay. And as you know, the markets have been anticipating a rate increase for quite some time, and that it will follow one of the FOMC meetings that has a press conference afterwards. Currently, there's a press conference after every other FOMC meeting, and as a result, in the market's view, the Fed only has 2 more chances to raise rates this year in September or December, even though there's an FOMC meeting later this month and one in October. My question is, would the Fed feel comfortable raising rates for the first time at an FOMC meeting without a press conference scheduled afterwards? In other words, are the July and October meetings on the table, so to speak, for rate increases?
I've tried to emphasize that every meeting is a live meeting. We could make decisions at any meeting of the FOMC, and we've emphasized that if we were to make such a decision, we would likely have a press briefing afterwards, and we recently conducted a test to make sure that members of the media, of the press, understand how technically they would participate in such a press briefing.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, Chairman of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Over here, Madam Chair. Thank you. A few weeks ago, we met and we had a long discussion about a number of different topics, and one of them was Operation Choke Point. And I asked you at that time, or made mention of the fact that I was very concerned from the standpoint that government oversight reform had this report that they put out with regards to the internal emails and memos that showed that the FDIC was going well beyond their statutory authority and duties in trying to limit the ability of certain legal business to do legal business, and was impacting a lot of banks in a very negative way. And the fact that you oversee some of those banks as well, I felt that you should be pushing back and have a meeting with Chairman Greenberg. And I ask you to do that. Have you done that at this point?
Yes, I have done that. I have discussed with Chairman Greenberg Operation Choke Point and our views about what appropriate policy is on the part of the banking agencies with respect to how our examiners deal with banks and the services they offer. We both certainly agree on the importance of making sure that examiners and our policies don't discourage banks from offering services to any business that's operating within state and federal law. He and I agree that that's appropriate policy, and we've discussed this
did he indicate to you, though, how he is going to stop Operation Choke Point within his own agency?
I don't want to speak about his
Well, I think it's
policies.
important that you make the point to him that he has to stop. In this report of his own emails within his department, he is implicated as being part of the problem. And therefore, it's important, I believe, that you have a discussion, say he has to cease and desist those kinds of activities and get assurance from him that he will make sure that's done.
He explained to me a number of policies that he has put in place to be absolutely certain that his examiners are abiding by the policy that I indicated, which is the banks we supervise, that examiners in examining them do not.
If at some point you find that this is still continuing, will you confront him about that? If it's continuing within the banks that you oversee, will you confront him and say, we find this to continue to be operational, and therefore you need to stop it? Will you stop him from doing that, if you see it?
I will continue to discuss with him this issue and to make sure that our policies.
All right. With regards to another issue we discussed with regards to civic designation, one of the concerns that I have, especially with insurers and asset managers, is as they're designated, there doesn't seem to be a way for them to become de-designated. There's no path that's written out. Obviously, you can say, well, they need to change their business model. But I would think that it would be helpful, whenever they're designated, to be able to say, if you do this, this, and this, these are the problems that have caused you to become designated. If you change these things, do these things differently, it would allow us to de-designate you. And I really don't see any path to de-designate. Can you elaborate a little bit on that?
Yes, well, FSOC reviews every single year the designations of firms and considers whether or not they're appropriate or are no longer appropriate. And firms that are designated are given very detailed material to enable them to understand the basis for the designation.
I would just encourage you every year to be sure you put something like that in there so there is some certainty on the part of those folks that are designated. I've got 30 seconds left, so I'm going to get one quick question in here with regards to the board's charged with adopting capital standards for federally supervised insurers. These capital standards are of concern from the standpoint that this is the first time that the Fed's ever gotten involved in domestic capital standards for insurance companies, and I know that through FIO, you're looking at international capital standards. My question is that would you commit to us of prioritizing that domestic capital standards will take priority over international capital standards?
Well, any international capital standards would not become effective in the United States unless a regulation, a rule were proposed.
That's my concern.
And went through full debate.
That's my concern. We want to make sure that the domestic insurance industry is protected. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and welcome back, Chairwoman Yellen. You were quoted in a June 17th American Banker's article as stating that the Federal Reserve was examining ways to improve its implementation of the Community Reinvestment Act amid concerns that regulators are letting too many poor communities go unserved by banks. How would the Federal Reserve's efforts seeking to improve implementation of the Community Reinvestment Act encourage investments in places like the ones that I represent, such as Ferguson, Missouri, and other communities throughout this country that are mired in poverty?
Well, we've been working to improve implementation of the CRA regulations with other banking regulators, and we've been doing that in part by trying to improve our guidance, adding to a set of interagency questions and answers on the community reinvestment. And we came out with additional Q&A in 2013, and we're working toward further additions. And so what this guidance does is try to clarify the ways in which basic banking services can help to meet the credit needs of low and moderate income people in the context of CRA. And by doing that, I hope what we will be doing is encouraging banks to consider providing the kinds of banking services that people in these communities need to be an important part of their CRA program.
Okay, and along those same lines of questioning, you stated in your testimony your concerns about the limited availability of mortgage loans. As a supporter of Dodd-Frank, has the law given us unintended consequences and tamped down banks' ability to lend money in order for people to get mortgage loans?
So it's hard to say. I mean, certainly lending standards are much tighter than they were in the run-up to the financial crisis. And I think most of us think appropriately so. We don't want to go back to lax lending standards. But it may be that the steps we've taken are having some unintended consequences, and that we need to work on that to make sure that credit is available.
So do we need to tweak the law in order to allow banks to really get money out into our economy and allow people to realize the American dream and purchase homes?
Well, there are a number of obstacles that banks see to lending. Some have to do with put-back risk, which are matters that the FHFA and was working on with Fannie and Freddie. There's remains uncertainty about securitization and the rules around securitization, so we've not really seen an active market come back for private residential mortgage-backed securities, and that could be part of what's happening.
Well, okay. The Federal Reserve released a report titled Strategies for Improving the U.S. Payment System, a follow-up to a 2013 consultation paper that signaled its intention to expand its presence in electronic payments. Why has the Fed embarked on this faster payments initiative, and what does it hope to achieve, and what is the Federal Reserve's plan?
So our basic plan is that we want to see a faster and safer payment system in the United States. We think that many steps can be taken to make that possible, and the main role we expect to play is that of a convener, to bring a lot of private sector participants to the table to talk through these issues. And for them, we've set up task forces on faster payments and safer payments. Hundreds of private sector participants are discussing what they can do in order to bring this about. So we're trying to play the role of facilitator of bringing people to the table.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman. Welcome, Chair Yellen. As you know, I chair the Oversight Committee on Financial Services, and along with Chairman Henschling, we've been doing an investigation into the 2012 FOMC leak. We have kindly asked for you to produce documents in regard to this leak. You have failed to comply. The chairman then issued a subpoena for those documents by which you failed to comply. So I would ask, what is your legal authority? Give me case law or statute that allows you to not comply with a congressional subpoena.
So first let me say that we have cooperated with the committee.
I have limited time, so I want to know, give me the legal authority that you have not to comply with a subpoena. We've asked for specific documents, and you haven't given them to us.
We have indicated that we fully intend to cooperate with you to provide the documents that you've requested.
Madam Chair.
But that we are not going to provide them now because this matter is the subject of an open criminal investigation by the board's Inspector General and by the Department of Justice. They have indicated to us that It will compromise, it will likely compromise their investigation.
You are the chair. Give me the legal.
If we provide
listen,
these
you can read the statement all day
at this
long, but
time.
I would like to know the legal authority that you have. I mean, basically what you said in the letter to Chairman Henschling and myself is that the OIG basically requested that you don't give it to us. You're not bound by the IG. You're not bound by the DOJ.
We've indicated.
You've asked for the documents. You've said we're not going to give it to you. Is it fair to say you don't have any legal authority because you can't give me a case law or statute that says you have an exemption
No,
from our
we've said that we plan to give them to you as
Just
soon
not
as
now.
we're able to do so
Because-
and not compromise an open criminal investigation.
Compromising
I think
open
we want to
investigation.
see this investigation succeed.
You do. Let's talk about that. You want to see it succeed. So let's talk about the timeline. This happens in October of 2012. You don't follow your policy. The general counsel does an extensive 6-month investigation. After that investigation, the general counsel is supposed to make a referral to the IG. That doesn't happen. General counsel gives a report to the committee, right? And when you get that report, because you are so concerned about justice, you're so concerned about bringing the leaker to the forefront, what do? Nothing. You didn't make a referral to the IG. You didn't make a referral to the FBI, the SEC, the CFTC, the DOJ. You did absolutely nothing. Zero. And so you're trying to say that Congress is going to obstruct your investigation when you had information. You did nothing to perpetuate an investigation that would lead us to the truth. Eventually, the IG did their own investigation, and then they closed it. And guess what? Congress stood forward and said, listen, this is important stuff. We just, as Elizabeth Warren would say, we just don't want to have those that are well-connected get information through leaks. We should know who the leaker is. And so it was because we pressured the IG with a closed investigation, and we pressured you, that all of a sudden there's now a second investigation. And they go, no, we can't give you that documentation now because it's a pending investigation. And we're concerned about you jeopardizing it. Madam Chair, it appears that you are the one who is jeopardizing, or the Fed is the one who's jeopardizing this investigation. Am I wrong?
The FOMC has in place a clear set of rules that are to be followed when there are allegations of a leak.
You didn't follow them.
They call for a review of the incident by the General Counsel and the FOMC Secretary. We've described to you how that review took place. It took place before the review was complete. The Inspector General
Did the General Counsel
informed our General Counsel
reclaim my time.
that he had undertaken.
Did the General Counsel, per your guidelines, talk to the FOMC board, or did he make a recommendation to the IG? Because the requirement is that they do an initial review and solely determine whether they make a referral to the IG. They didn't do that, right? Alvarez didn't do that.
Before his review was complete, he was informed by the IG that the IG had undertaken his own investigation, and therefore the IG was already looking at it before it was necessary for him
Madam
to
Chair,
make a decision to refer it to the IG.
My time is almost up.
The IG was
I wanna
already
reclaim my time.
involved.
If anyone is trying to sweep this under the rug, it's the Fed. It is Congress that's trying to bring light to this. I sent you a letter in response to your denial with Chairman Henschling on the 17th of June. And we have almost a full page of footnotes where Congress has done oversight during an open pending DOJ prosecution. We have the right to these documents. You have the duty to provide them to us. You have cited no legal authority to deny that request. We are entitled to do oversight. You're required to give us the documents. I hope that you will reconsider your denial. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Alabama, Ms. Sewell.
Thank you, Mr. Chair, and thank you, Chair Yellen, for being here today. I wanted to bring your attention to the wages and what I see as income inequities that are going on, and really get your take on what we can do as far as monetary policies to close that gap. Since the height of the financial crisis, the U.S. economy has made remarkable progress, particularly in compared to other parts of the world. Here in the United States, the unemployment rate fell from 10% to 5.3% in June. And the President has pointed out in his budget over the past 4 years that we've put more people back to work here in the United States than Europe has, and in Japan and other nations. However, despite the overall employment gains, there are still some districts, mine included, that have folks who want to work who haven't been able to find work. The hourly labor compensation has been tending to lag behind the growth in particular, and the President's budget projects that the share of national income going to labor rather than to capital will remain at historic lows for years to come. What, in your view, can and should be done to reverse this trend and ensure that workers reap more of the rewards and gains from our growing economy? I'm particularly interested in the disparity that exists among minority unemployment. I can tell you that in my own district of Alabama, while the overall nation has 5.3% unemployment, our median average unemployment in a district that is disproportionately African American is right at 9 to 10%, which is vastly different. Would love to know how you think our monetary policies can go about changing that trend.
So monetary policy has been aimed at trying to achieve a strong recovery in the job market, and while we're not there yet, I believe we've made substantial progress. As the economy improves and the labor market gets stronger, I would expect to see the growth of wages pick up over time. And at this point, I think we're seeing at least some first tentative signs that wage growth is increasing. It's been running at a very slow pace. There are often lags between improvement in the labor market and a pickup in wage growth.
Do you think unemployment rates, is it more because of structural changes or cyclical factors with respect to?
Both cyclical and structural factors matter. So cyclically, as the labor market picks up, I think the pace of aggregate wage growth will pick up. But structural factors are also very important. Productivity growth matters over time to real wage increases, and productivity growth in recent years has been frankly very disappointing. That may be holding wages down. But across groups, differences in wage trends across different groups in the labor market, I think, reflect a deeper set of longer-term structural influences and go way back to the late 70s or mid-70s, where we've seen growing gaps by education. We've seen a persistent increase in the returns to high-skilled workers and stagnation at the middle and at the bottom.
Do you think that any changes in our tax or spending policies could help close that gap quicker? I get that, systemic problems and persistent poverty cause lots of segments of the population to have their unemployment lag behind sort of overall unemployment, but really want to know if there are any substantive things that we can do as far as our tax policy or spending policies that would hasten the closing of that gap, that unemployment gap.
Well, there's a large literature on this, and many economists who have made suggestions about things that Congress could consider that would address inequality. Certainly with a high return to education and skills being a very important factor in determining wage outcomes, policies that address education at different levels
Are there any
would be
particular
relevant to
policies that or outreach efforts that the Fed has made in order to really understand this, the difference in communities of color with respect to the wage and income inequality?
We do have surveys. We're trying to collect information, household surveys that enable us to gain better insight into this, and we have community development efforts that are addressed to low and moderate income communities to try to see what could be done.
Thank you for your efforts, and I hope that you'll continue them.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Tennessee, Mr. Fincher.
Thank you, Mr. Chairman, Madam Chair. I appreciate you being here today, and I'm going to get right to the point. We're going to talk a couple of lines of questions, cost-benefit analysis, and then about raising interest rates and what kind of impact that'll have on national debt versus personal debt. And the committee room being remodeled, I also have been watching the TVs, which are very informative, and the charts that I think are being shown by my colleagues on the other side of the aisle, if we would just change the top to progress that's been made since Republicans took control of the House in 2011, then I think the charts are great. So appreciate my buddies on the other side of the aisle get a big kick out of that. Back to cost-benefit analysis. The small, medium-sized banks, lending institutions all over the country, the impacts of Dodd-Frank being burdensome, overburdensome. Just 2 or 3 questions, and you can answer, we'll move on. Does the Fed's independence in setting monetary policy mean that financial regulations are above the law, 1, and has anyone at the Federal Reserve done an analysis of the cumulative impact of Dodd-Frank regulations on broader economic variables such as credit availability, economic growth, capital formation, and perhaps most importantly, job creation? Now, the CFTC, SEC, these other agencies do this. Why aren't you doing this, and can you shed some light on why you're not, and would you be open to doing it?
Well, we do a great deal of analysis to try to understand the costs of regulations that we put in place and their benefits. For example, with respect to the Basel III capital requirements, we participated along with other countries in a very detailed cost-benefit study of the likely impact of raising capital standards. We came to the conclusion that even though there might be a very modest burden on raising spreads and the cost of capital to the economy, that the costs of financial crises had been so dramatic and so large that the impact that we would have of reducing the odds of a financial crisis, it passed a cost-benefit test easily. We regularly make sure that we comply with the administrative.
So are you, not to interrupt, but my time is slipping, but would you be open to doing a specific cost-benefit analysis for every big decision? Because what you're saying there, I get what you're saying. I know it's very complicated, but you're saying, well, in order to make sure that we don't hurt this one over here, we're doing this one here. But, you know, we really are not going to give you the information that it's not cut and dry, which we need more than we're getting. Would you be open to doing a cost-benefit analysis, yes or no?
Well, we do follow the analysis that's required by current law. And in some cases, I think it would be difficult to do that. After all, Congress is, for example, in Dodd-Frank, already made a judgment that they want to see us put certain requirements into place based on Congress's judgment that it would make the financial system safer and sounder. We put out proposed regulations for comment to try to accomplish an objective that Congress has already assigned to us because they've determined that it would be beneficial.
Okay, reclaiming. It's just, it seems like a common sense approach. I know it is very complicated, but that we would have, again, the SEC, CFTC, other agencies are doing, that we have a common sense approach, cost-benefit analysis. And I think you're saying that you're not in favor of doing it this time. Maybe Congress needs to, maybe we need to do something else. Let me move on, but you're not in favor of it. Raising interest rates, nationally, the debt that we owe, we see the current national debt. Personally, the debt that many Americans owe in this country. When we start down this path of raising rates, I'm afraid, you know, there's a whole generation of people now that think the interest rate standard, 0% is the standard because they don't know what interest rates back when I was a kid, when interest rates were 18, 20% under the Carter administration. But when you start up down this path of raising rates, My theory is we go into another recession, then you can't raise rates again because rates are already low because you haven't raised them much anyway. And then the only answer is more quantitative easing, more dumping money into the economy. And that gets very serious very quickly. Do you fear that raising rates is going to do this? I know my time is...
We're not going to raise rates if we think it's going to tip the economy into a recession. We will raise rates because we believe the economy is strong enough that it is appropriate to have higher rates to meet the objectives we have been assigned by Congress. And
this is a concern for you as well.
So we wouldn't do something that would jeopardize a recession unless inflation were at risk.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for appearing today. On page 12 of your report, you note that net exports, that is to say trade imbalance, has been a substantial drag on GDP growth. The House and Senate will soon go to conference on a customs bill that was part of a trade package that was mostly passed into law last month. So my concern is, and continues to be, around the potential for our trade partners to undermine the value that free trade agreements can have without strong enforceable prohibitions on currency manipulation. During the trade debates, the administration put forth the position, they basically insisted that it was impossible to define currency manipulation in any way, for example, with the IMF definition of currency manipulation, in any way that would not have significantly impinged on your ability to have accommodative monetary policy, including quantitative easing, in response to the downturn. So my question to you is, do you agree with that? And specifically, in what ways would for example, the IMF definition of currency manipulation prevented you from accommodative monetary policy?
So I do agree with the concerns that were expressed about currency manipulation. So first, let me make clear that I'm opposed, and the G7 and G20 have weighed in, that intervention in currency markets by governments for the sake of changing the competitive landscape and purposely trying to divert trade to a country is wrong. It's inappropriate behavior. Our Treasury Department is deeply engaged with other countries when they think they see that.
The question is it possible to make actionable objective criteria of the defining currency manipulation which would not have impinged on what we had to do in response to the crisis?
I believe it's difficult because many factors influence the value of currencies that are traded in markets.
As you're aware, the IMF definition does not talk about the value of currencies. It talks about action. I mean, it has three indicia. You have to be running a persistent trade surplus, you have to be accumulating additional foreign exchange reserves, and you have to be holding excess foreign exchange reserves. It's my belief that none of those three would have been triggered by all of our response. And the question is, and so that the administration's position was just fundamentally wrong, that IMF definition would have prevented us from the accommodative monetary policy that was so important to rescuing our economy.
So my concern with this is that I think it's important for countries to be able to conduct monetary policies that best pursue domestic objectives. Those policies are not intended to impact currencies, but because they do affect interest rates, and interest rates affect global capital flows, they have impacts on currency values. All I have said about this topic is that I would worry about any type of legislation that could cripple monetary policy from achieving the objectives that Congress has assigned us.
I understand you're worried about it. The precise question is there anything you did that would have triggered the IMF definition of currency?
I'm not sure.
Would you be able to get back with us?
I haven't studied that carefully enough, and
Okay. Would it be possible for you to get back with an answer for the record of that precise question? Thank you. I really appreciate that. Let's see, I have a little bit of time left, so I guess, are you familiar with, I'm a physicist, are you familiar with Albert Einstein's quote that any theory of the universe should be made as simple as possible but not simpler? And are you ever reminded of that quote when you talk about these things like the Taylor rule, where you imagine that the entire universe can be reduced to a linear relation between a handful of variables?
I think that's a very good point, and I think it is apropos of the Taylor rule. It would be nice to be able to reduce appropriate policy to the current values of two simple variables, but I think the world is more complicated than that. We can't take everything into account, but there are important things that need to be considered, and that's why we have an FOMC that has been asked to bring a great deal of information to the table.
Right, and the last thing is sort of a mathematical corollary of that, which is that if you have something that's really a function of many, many variables, and it is changing over a period of time in response to a single one of those variables, that doesn't, that obviously does not mean that the real response function is a single variable, single function of a single variable. Which is, I think,
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. Chair Yellen, in your first appearance as Fed Chair before this committee, you commented on the need to move forward with housing finance reform, and do you continue to believe the current state of our secondary mortgage market poses a systemic risk, and should Congress and the FHFA be taking steps to share that public risk backed by taxpayers with the private sector? Secretary Lew suggested such an approach that would have his support.
So, I mean, I've long said, and my predecessors have as well, we think it would be desirable to see Congress address GSE reform, to decide explicitly, self-consciously, what is the appropriate role of the government in the mortgage market, and to try to bring private capital back into the mortgage market. There are a number of ways, different strategies Congress could take to accomplish that, but I do think it's important for Congress to try to resolve those issues.
Thank you. Chair Yellen, last year I, along with other members of the House Financial Services Committee, wrote to Treasury Secretary Lew and copied you regarding our concerns about FSOC's lack of a formalized process for reviewing non-bank financial institutions facing designation, and we shared concerns about the FSOC's need to conduct a thoughtful review of the insurance industry before moving to designate individual insurers. Since sending that letter, the FSOC has taken additional steps to understand the asset management industry, which were clearly needed after the flawed Office of Financial Research report. Specifically, Federal Reserve Governor Tarullo has endorsed an in-depth market-wide analysis and an activities-based systemic risk review, but the FSOC has still not taken steps to study and better understand the insurance industry. So, do you think it would be appropriate to conduct a thorough study and analysis of the insurance industry as well? Shouldn't all non-bank financial institutions face a similar process for review?
So, I mean, the asset management industry is one where FSOC thought it appropriate to focus on activities and to look at whether or not there are systemic risks associated with some asset management activities. Examples would include liquidity and redemption risk and use of off-balance sheet leverage. With respect to insurance, I mean, this is not a matter of going from reviews of individual companies to the activities type of approach. It's not something that FSOC, to the best of my knowledge, has discussed.
Let me go then to my last question. In February of 2014, I asked you about the deepening economic crisis in the Commonwealth of Puerto Rico. You said then that the Federal Reserve was monitoring developments and continued to analyze the potential consequences for financial stability of these events. You also said that it would be best to not have the Federal Reserve step in as a creditor of a state or municipality. In fact, you said that it is more appropriate for Congress and not the Federal Reserve to address financial issues faced by states and municipalities. Do you believe here that the best outcome would be that Puerto Rico Electric Power Authority and its creditors come to an agreement without any government intervention with respect to this issue?
Without what intervention?
Without government intervention, but instead work it out between the Power Authority and the creditors.
So this isn't a matter in which I have an opinion. I mean, the Federal Reserve, it's something the Federal Reserve can't and shouldn't be involved in. I think it's appropriate for Congress to consider what's best to do in this case, and it's not it's not a question on which I have an informed judgment. What we've been doing is, obviously monitoring developments in Puerto Rico, which economically are very, very difficult. We're looking to see, are there risks that are being transmitted to the broader municipal debt market, and we're not seeing signs of contagion. That's another topic that is obviously important, but exactly what should be done in this situation, I think, is a matter for Congress to consider.
In the past, you said it's best to not have the Federal Reserve step in as a creditor of a state or municipality.
And I continue to believe that very strongly.
Thank you very much.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman, and thank you, Ranking Member. Thank you for being here today. And let me just say that we were very proud to have you last week in the great state of Ohio. Although it was not Columbus, the capital, we would certainly look forward to having you come just a few miles north to visit us. My first question is to follow up on Congresswoman Waters' question when she asked about discrimination in the loss of wealth base on subprime lending. And in part of your answer, I'm not sure if you got to finish, when you said that there were some other policies that Congress could pursue to address discrimination and inequality. Can you elaborate on what those policies are?
Well, I meant more broadly in terms of inequality among households in terms of wealth and income. There are many factors that affect inequality. They tend to be deeper structural forces, including technological change that's increasingly up the skill demands for our workforce and raise the return to skilled workers relative to those who are less skilled. Certainly education, training are matters that are within Congress's domain to consider how to make sure that individuals have access to a world-class education that's going to enable them to earn a higher wage. Policies affecting infrastructure and capital formation, entrepreneurship, other things also affect trends in inequality, and I was referring to all of those factors where Congress could potentially play a role.
Okay, thank you. When you were here in February, before this committee, January's unemployment rate was about 6.6% overall. About 4 months after that, the rate decreased to about 5.3%. However, in African American communities, while it declined, it went from 12.1% to 9.5% over that same period. And while African Americans' unemployment rate did decrease, the number is still high. In fact, it's double the national unemployment rate, and I think most, and you included, would agree that that's unacceptably high. So my question is, as you assess the health of the labor market, to what extent are you taking into account the fact that minority communities still face unacceptable high rates of employment, and is there any outreach or anything that the Federal Reserve has engaged in to understand the extent in communities that I represent?
So there really isn't anything directly that the Federal Reserve can do to affect the structure of unemployment across groups, and unfortunately it's long been the case that African American unemployment rates tend to be higher than those of on average in the nation as a whole. It reflects a number of different sources of disadvantage that are operative there. In our national monetary policy, we're trying to achieve a situation where jobs are broadly available in the economy to those who want to work, but we seek the maximum sustainable level of employment, or we have to be careful not to try to push the economy to a point we have to worry about inflation remaining under control. And given our focus on inflation, there are certainly limits on what we can do for any particular group.
Okay, thank you. I have a few seconds later. Let me continue in this theme on the other side as I talk about the Office of Minorities and Women in Inclusion. Certainly, you know Section 342 that created the office, and part of the thing that we've struggled with is the whole reporting authority and the standards for reporting back what those federal regulation offices are doing. Do you have any insight on that? It's the OMWI program.
I'm sorry, I mean, we make each of the federal agencies or entities that are covered by this make annual reports to the Congress. So the board is reported annually on our efforts, and we are let me just say, we are very committed to doing what we can to facilitate inclusion of minorities and women, and we have many programs and have tried to detail them in those reports.
Time of the gentlelady has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner.
Thank you, Mr. Chairman. Chair Yellen, thank you for joining us today. I want to touch on some issues that some of my colleagues have also brought up, but keeping in that vein, and particularly with the news coming out of Greece for the past few weeks, I think it is important for countries to take a hard look at their own debt. Time for us to look in the mirror and address our own problems, including the over $18 trillion in debt that we have accumulated. Now, the Federal Reserve has employed an, I'll say, exceptionally accommodating monetary policy since the financial crisis to spur economic growth. However, we are now nearly 7 years, ma'am, out with the federal funds rate still at the lower zero bound. Both quantitative easing and low interest rates have made financing of the nation's deficits much easier and certainly has relieved pressure to enact real fiscal reforms to solve our long-term debt problem. Chair Yellen, both you and your predecessor, Chairman Bernanke, have argued that fiscal reform is important over the long term. However, you have also stated that fiscal prudence can be ignored in the short term to not hamper the economic recovery. Chair Yellen, it has now been 7 years. We can no longer say we are looking at the short term when we are dealing with our country's debt problem, can we?
So, like my predecessor, I believe the nation faces a very serious debt problem in the years ahead. At the moment, deficits, mainly because of congressional actions and those by the administration, have succeeded in lowering deficits to the point where for the next several years the debt to GDP ratio is stable. But over time, under CBO projections, as the population ages, and especially if health care costs rise above trend, as has been historically typical, the country will face an unsustainable debt path in which debt to GDP ratio rises, and that requires further actions. That's mainly related to retirement programs, to Social Security, and even more important, to Medicare and health care cost trends. And so we've known about this for decades, and there remains a need for action on this front.
There does remain a need for action, and citing those latest CBO long-term budget outlook reports on some of the consequences of large and growing federal debt. This comes again from the CBO's long-term budget outlook. It cites things like less national savings, lower income, pressure for larger tax increases or spending cuts, reduced ability to respond to domestic and international problems, and a greater chance of a fiscal crisis. Are these things that you all consider at the Federal Reserve with regard to monetary policy?
I agree with the set of consequences that you just read to me. And ultimately, when we see those things being manifest, those consequences, so in the years ahead, if deficits aren't addressed and become very large, they will put pressure on the economy that, not right now, but in future years, likely will cause us to have higher levels of interest rates than we otherwise would have, diminished levels of investment and productivity growth in this economy. We would have to offset those forces by having a tighter monetary policy. And we're not in that situation now.
Particularly relating to long-term debt leading to a greater chance of fiscal crisis, as they say. Is this something you discuss as part of FSOC when you're looking at systemic risk?
I've not been part of an FSOC discussion of this, but it obviously is a significant issue for the long term.
I have a short amount of time. When do we get to the long term, Chair Yellen? When are we there after 7 years and adding $8 trillion in debt over the last handful of years? When do we get to the long term?
The economy is recovering. I'm pleased by its progress. As I indicated, my colleagues and I think if the economy progresses as we expect, we probably will begin to raise interest rates sometime this year, and that takes us toward the long term.
And how does that affect our current debt, Chair Yellen?
Well, two ways. Higher interest rates will raise the cost of servicing the debt, but a stronger economy, which is what will cause us to raise interest rates, the stronger economy boosts tax receipts and is favorable for the federal budget.
Thank you.
Time of the gentlelady
I always
has
appreciate your being here.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Michigan, Mr. Kildee.
Thank you, Mr. Chairman. Chair Yellen, thank you for being here. I'm blocked slightly by Mr. Emmer, who is functioning as a pulling guard, I think, right now. Got good coverage. The work that I did before I came to Congress, and a lot of the work that I've been focused on since I've been here, relates to the economic health of America's cities and towns. And I know that a lot of the regional banks, most notably Boston, Cleveland, Chicago, and in some other ways Philadelphia, have been focusing some attention on this issue of the fiscal health of communities within their supervisory area. And I've raised this with your predecessor and again with you, and I'm curious as to whether the Board of Governors might in the near future take up this question. What we have, and I've talked about this before, I know other members have heard me go on about it, we have an pending, looming institutional failure in this country. I mean, there's often a tendency to think about cities facing significant municipal stress as being anomalies or having that problem as a result of significant mismanagement or an episodic sort of fiscal stress situation. But what we're seeing and what the data shows us is that there is a structural problem. Municipal governments of all types are facing enormous stress, hundreds of millions of dollars in general fund revenues and expenditures in many, many dozens of these municipal institutions that are facing potential failure. And while I know the Fed has involved itself most recently in the question of municipal bonds, potentially as a source of liquidity for banks, looking at the municipal financial situation from the investor side is only one half of the equation. And I think it is overdue that the Fed, with its strong voice and its dual mandate, particularly its mandate related to employment, take a look at the potential employment impacts of the failure of dozens, potentially, of American cities that are really central to our economy. And I wonder if you might comment on the problem and offer, any thoughts as to whether you think the Board of Governors might take this question up. I think it would be an important issue to take up.
Well, that's something I'm happy to raise with my colleagues. I am well aware of the work that's gone on in a number of reserve banks. Our reserve banks all have active community development functions, and many of them have been very focused on often older cities or cities that have suffered declines, some cases because of the decline of manufacturing, and trying to help them work toward strategies that would lead to their revitalization. And they've done some very creative work. A number of them have. So I can discuss with my colleagues what we might do in that space. I am pleased to see the efforts and the good work that many of the reserve banks have undertaken. I think it's been helpful to community leaders as they, try to devise strategies for revitalization.
Thank you. And I would just encourage you to look at this as potentially a part of the work of the Board of Governors itself, and looking at the role that the banks, the regional banks have done. It's important, but I think often what happens is when it's looked at from the perspective of a region, it is seen as an anomaly. And I think if the Fed would be willing to use its research capacity to help elucidate to many policymakers that not only does this problem have a potential negative impact on employment, but it is a structural and pervasive problem that goes beyond what normally had been seen as an anomaly or as an episode based on management failure or some unforeseen circumstance. It's a structural problem, and I really do think it fits well within the responsibility of the Fed to look at.
I appreciate your suggestion. I know a number of years ago the reserve banks collaborated to initiate work on this topic. They chose a number of communities around the country, cities that were hard-pressed, and tried to work on understanding what strategies work to revitalize these different kinds of communities. And it could be collaborative work the reserve banks undertake together.
Thank you very much. I appreciate it.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr.
Chair Yellen, welcome back to the committee. And I wanted to talk to you a little bit about the low-rate policy that the Federal Reserve has pursued now for, well, it's effectively almost a zero short-term interest rate policy that the Federal Reserve has pursued now for 6 years. One of the original targets that the Fed set to begin raising rates was when unemployment reached 6.5%. We are well below that target now, as you testified today, about 5.3% unemployment. And I appreciate your testimony that you expect to raise the target federal funds rate gradually by the end of this year. But what I want to explore are the reasons why the Fed has delayed normalizing monetary policy beyond the point that you originally targeted for increasing rates, and what that says about a few issues. First of all, what does it say about the unpredictability of Fed policy? And I appreciated your testimony that effective communication is critical, that transparency is desirable, but doesn't the fact that we are below 6.5% unemployment now for almost a year and a half, and you still haven't raised rates, doesn't that undermine the commitment to transparency and the commitment to communication?
Well, I want to make clear that the 6.5% was never a target that we said we never said we intended to raise rates when unemployment fell to 6.5%. Instead, we said it was a threshold, and if unemployment was above that level and inflation was well under control, we would not raise rates. That once unemployment fell below that level, we would then begin to consider whether it was appropriate to raise rates. And we have followed that policy, and we never said that it was a target at which we would begin
I understand
to raise
that,
rates.
and I appreciate the caveats, and I appreciate
Well,
the
it's
fact
more
you're
than a
very good at
caveat,
caveats. You're very good at caveats. I appreciate that. But I think that brings me to my second point, which is that a full 6.5 years after the recovery, even though we've seen a decline in unemployment, as you acknowledge, there's slack in the labor market, and there are significant weaknesses in the labor market, in the overall economy. In fact, a recent Investors Business Daily article said that the overall growth in the 23 quarters of the Obama recovery has been 13.3%. That's less than half the average growth rate achieved at this point in the previous 10 recoveries since World War II. Looked at another way, had the Obama recovery been merely average, GDP would be $1.9 trillion larger than today. That translates into $16,000 per household. And I think you recognize this in your report, saying that the measure of labor underutilization remains elevated relative to the unemployment rate, and that would explain why you've invoked that caveat and haven't raised the rates, even though you came below that 6.5%. So I understand that analysis, but let's talk about the cause of that underlying weakness. It's clearly not monetary policy from your standpoint, because you've engaged in these extraordinary measures, 6 years of zero rates, very accommodative policy, bond buying, quantitative easing. Shouldn't we start looking at fiscal policy? Obamacare, which CBO says is contracting employment by 2.5 million jobs, the 30-hour work week, which is forcing people to go part-time, the EPA's rationing of energy, 8,000 lost coal miners in my state, and we're losing employment by the day. Dodd-Frank, American Action Forum says that over the next 10 years, Dodd-Frank will reduce GDP output by almost $1 trillion. And just last week, one of your colleagues on the Federal Reserve Board, Governor Lael Brainerd, acknowledged that regulations may be a factor in diminished fixed income liquidity in the capital markets. You know, the Federal Reserve has gone to extraordinary lengths to produce robust economic growth, and yet we see this lag and this slack, as you say. Shouldn't we start diagnosing the problem differently, that this is a fiscal policy disaster?
Well, of course, it's appropriate to look at why we've had such a slow recovery. It really has been painstakingly slow getting the economy to the point where unemployment is 5.3%. Remember, we had a devastating financial crisis. It took a huge toll on households, left many of them struggling with debt, with massive losses in wealth, underwater on their mortgages. They've been trying to get that debt under control. Businesses have been very cautious about investing. We are partly living with the headwinds from that crisis.
Just one final point. I think, low rates are not the problem. And in fact, what I'm concerned about now is that because we've delayed raising rates below that 6.5% unemployment rate, now we have no tools left. And what's your response now if we go back into recession with a $4.5 trillion balance sheet and zero rates? We have no tools to address the next recession.
The time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Murphy.
Thank you, Mr. Chairman. Thank you, Ranking Member. Chair Yellen, thank you for being here. Starting sort of big picture, I think one of the biggest problems we have in our country is the disappearing middle class. And one of the factors that isn't addressed in that conversation is often housing. And in a state like mine in Florida, you go to areas like Miami, Coral Gables, there's a lot of growth. And in fact, a lot of the numbers there for growth are through the roof, way better than ever expected. But unfortunately, that is for folks that have the 700-plus credit scores, and the middle to lower middle income families, especially a lot of the minority communities, are not experiencing this bounce back, nor are they building that equity. I think is important to getting to that middle class. So my question relates to regulation, and curious as to when you think the Federal Reserve will be able to finalize its list of domestic systemically important banks, so that this committee can have an idea better than just the $50 billion line, which American banks are the vanilla, sort of making that 30-year fixed rate mortgage and the small business loans important in our community versus the ones that are truly the most risky. So
I'm not sure exactly what
you
you're...
intend to finalize the list of domestic systemically important banks?
Well, we have 8 domestic banks that have been designated globally as GSIBs. They're among the banks that are over $50 billion and subject to the enhanced prudential standards in Dodd-Frank. And those banks we have, for example, subjected to a higher leverage requirement than other banks. We supervise them in a different process, and we will be proposing enhanced capital standards or surcharges for those 8 systemically important banks. But others that are not in that group also are important and have systemic significance and are subject to enhanced prudential standards and supervision.
And will you be putting that list out?
The list exists.
Other than the GSIFIs?
Well, I'm not sure it's what list. I mean,
for what I just said, for the domestic systemically important banks. And there's been a lot of conversation here in the committee as to whether it's just a $50 billion, what I would say, arbitrary line that's being considered versus things like interconnected derivatives, suitability, et cetera, and if that's going to be taken into consideration.
well, we give special attention to all banks that are over that threshold, but they differ in terms of their characteristics. And we have tried throughout tailor supervision and regulation to the systemic footprint of the bank. So there is no list of banks that meet this criterion. There are, of course, several that have been designated for supervision by FSOC that are, also subject to enhanced supervision.
Okay. Switching gears a little bit, we've already had some discussion on this as it relates to employment. Most economists say 5% is full employment. Right now, U3 is at, 5.3%. So we're pretty close there. Why do you think we haven't had and felt that wage growth yet? And what do you think needs to be done to feel that?
Well, so first of all, I think there is more slack in the labor market than you would think by the 5.3% measure, somewhat more. And I've pointed to the very high levels, unusually high, and we detail this in the monetary policy report, the fact that involuntary part-time employment is unusually high given the unemployment rate. So that's one factor. In addition, I think that labor force participation, while it's mainly declined for demographic reasons, there remains some component of depressed labor force participation that does reflect a weak economy, a weak labor market, that more people would rejoin the labor market if it were stronger. So to my mind, the U3, the 5.3, somewhat overstates just how strong the labor market is, but there are also lags in the time the labor market strengthens and wage growth picks up.
What rate do you think policymakers should use as full employment?
The time of the gentleman has expired. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Welcome, Chair Yellen. Last week, the Federal Reserve Board approved the merger of a $188 billion bank with an $18 billion bank. This will put the new entity above $200 billion. In the Federal Reserve's final order approving the merger, it analyzed the financial stability implications of the merger. The Federal Reserve noted that the merger did not present a meaningful greater risk to the stability of the United States financial sector. In analyzing the stability implications, the Federal Reserve used a factor-based model. Chair Yellen, based on the analysis in the final order, should we consider this analysis an endorsement by the Federal Reserve of a factor-based approach to measuring systemic importance and financial stability?
So the Fed staff looked at the detailed circumstances surrounding the characteristics of this particular merger and tried to arrive at a reasoned judgment, taking many different factors into account of whether or not this would create a financial stability threat. And they didn't use just a formulaic approach, but they looked at the details of the situation.
So the factor-based model worked in this case?
They listed a number of factors that they took into consideration, and that's a useful list, but then they did detailed analysis.
Chair Yellen, as you know, this month marks 5 years since the enactment of the Dodd-Frank Act. At the signing ceremony, President Obama proclaimed that the law would help lift our economy and lead all of us to a stronger, more prosperous future. Yet since that time, the law has resulted in some 400 new government mandates, which research has shown will reduce gross domestic product by $895 billion over the next decade, or $3,346 for each working age person. These costs are a large reason why more than 17 million Americans are still unemployed or underemployed today, why the percentage of adults who are employed or looking for work is just 62%, the lowest in 37 years, and why even Bernie Sanders has admitted that an honest assessment of real unemployment in the U.S. is 10.5%. In your speech to the City Club in Cleveland last week, you said, quote, growth in real GDP has averaged only 2.25% per year since 2009, about 1 percentage point less than the average rate seen over the 25 years preceding the Great Recession. I would note that by comparison, the GDP growth rate for a comparable period after the Reagan recovery was 4.8%, and that was a recovery marked by less regulation, lower taxes, compared to the higher taxes, higher regulation environment we have here. Considering that average 2.25% per year since 2009, that number hides quarters where we actually contracted. For example, in both the first quarter in 2014 and the first quarter in 2015, the economy actually shrank. Is that correct?
According to the statistics we have, yes.
In light of the negative growth in those quarters, I'd like to draw your attention to the slide that has been shown by my colleagues from across the aisle. I don't see any negative growth quarters in that. Do you think this slide is an accurate reflection of the economy's GDP growth?
Well, it looks like the numbers you have on this chart are year-over-year numbers rather than quarterly numbers.
I am counting the bars between 2011 and 2015. I see more than 4 bars there. I see quite a few bars, so it's hard to see what is represented here. What I don't see are the negative quarters that we've had in there.
Well, so I don't know, this isn't my chart, but
would you agree that the chart does not show the negative quarters?
I don't see the negative quarters. I see your label says year-over-year.
But you do see more than 4 or 5 years there between 2010 and 2015, or more bars that would represent.
Year-over-year often means the fourth quarter of one year over the fourth quarter of the previous year, or the third quarter over the third quarter of the previous year. And because negative quarters are infrequent, typically in a fourth quarter, year-over-year.
Negative quarters and near zero quarters, which we also missed in that chart. I'd be interested in your perspective, given these anemic GDP numbers, when you compare a 2.25% growth since 2009, and your own acknowledgement that that's a percentage less than the 25 years preceding the Great. This is the more accurate slide, by the way, which does show the negative or near zero growth in some of the quarters. Okay. Given that anemic growth, 2.25%, and you compare the deregulatory, lower tax environment in the 1980s where we had 4.8% growth, do you think Dodd-Frank has lifted the economy?
Well, I think Dodd-Frank has led to a stronger and more resilient financial system. And the years that you showed on your previous graph that were negative and year-over-year negatives, that was what we suffered in the financial crisis, a huge loss in output and in jobs. And to have a stronger, more resilient financial system means the odds of such a devastating episode is dramatically reduced.
Time of the gentleman has expired. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chairman. And Madam Chair, thank you so much for being here. I am aware that there is an accumulating amount of research and scholarship, as a matter of fact, kind of tracking the long-term decline of entrepreneurship and business formation. Fewer businesses are being started and fewer are living past the first or surviving past the first year. And as we all know, there's a declining number of community banks in this country. So my question to you is, what can you do and what can we do to help community banks serve their local economies?
Well, community banks are really vital to local economies. I've seen this firsthand when I was in San Francisco and president of the Reserve Bank there. It's something we're very focused on at the Federal Reserve. We want to see community banks thrive and know that for many different reasons, this is a very difficult environment for community banks. The slow pace of economic growth and recovery that we have had, the low interest environment is squeezing their margins, and the regulatory burdens that they face have been really quite high, and they're struggling with it. For our part, we're looking in the way that we supervise community banks to do everything within our power to reduce the regulatory burden. And I could give you a list of things that we are doing to try to minimize the burden: more off-site exams, more special tailoring of our exams to the risk profile of the bank.
If I could reclaim my time. Thank you.
Sure.
Kind of in the spirit of this, Congresswoman Beatty asked you about what you could do specifically to help communities of color who have disproportionately high unemployment rates. And you indicated that you don't have specialized tools. I'm going to respectfully disagree. And I would encourage you and others at the Fed to take note of some recent research done by a graduate student at MIT named Mr. Nguyen, who indicates that when community banks branches leave census tracts where there is a concentration of either low income or communities of color, that local business lending declines precipitously, even when there are other national or international bank branches retained in that community. He tracks that it's not true with mortgage lending, but it is true with small business lending. And with all due respect, Madam Chair, you have merger approval authority oftentimes when community banks are purchased and could make conditional the continuing presence of branches in those census tracts or in those neighborhoods where we have begun to document a decline. So with the little amount of time I have left, I'm always interested in your opinion about what you see as the threats to our continuing recovery. And I will use this opportunity to suggest that I don't think it's as robust as it can be. You and I have had the conversation about the output gap and the dire need for the Fed to begin to think of itself differently as it relates to investment in infrastructure, but I'm not going to go there today with you. What do you see as the threats that could induce, or the factors that could contribute to another downturn in the economy? What are you worried about? What keeps you up at night?
So let me first start by saying that I do think the economy has improved a great deal, and in a way I'm focused on the economy's strength and its good performance rather than mainly lying awake at night and worrying about a further downturn.
But the Fed has reduced the projected growth rate of the GDP by 20% in just the last few years, from 2.5 to 2.8 to 2 to 2.3. That's a material downward projection. But the question still is, what's out there that worries you?
Okay, so let me just say that the writing down of our projections on growth in part reflects the fact that productivity growth has consistently disappointed now for a number of years. So our unemployment projections have proven more accurate than our output projections. In essence, we've had decent job growth and better job growth than you would have anticipated, or we would have anticipated, with weaker growth. So in part, it's a reflection of quite disappointing productivity growth.
The time of the gentleman has expired. The chair now recognizes the gentleman from Arizona, Mr. Schweikert.
Thank you, Chairman Hensling. Madam Chairman, first, on a personal basis, you've always been very kind to me, particularly on some of the more abstract questions I have thrown at you. But in a couple of the conversations here, there's been the discussion of interest rate policy, ultimately what it does to us, and our fiscal policy. In an FOMC meeting, does it ever reach the level of conversation of, as interest rates go back to some level of normalization, what it actually means to our debt and deficit and, the projection of our financing costs?
Well, that is something that our staff looks at and I've looked at. Congress should expect, and this is embodied in CBO projections, that as the economy recovers, short-term interest rates will rise. Long-term interest rates already reflect that, and as the years go by, if short-term interest rates do indeed rise with a recovering economy, long rates will move up further, and this will affect the interest burden of the debt, and other things equal will add to deficit. So that's clear, but it's also true that a strengthening economy means stronger tax receipts. So
well, you and I see that somewhat as obvious, but I see many of the discussions around here when we're looking at an environment where the reports are telling us in just a few years, interest is going to equal our entire defense budget, and that's actually with the new normal, we'll call it the new normal, interest rate models we're heading towards. So my great fear is current monetary policy ultimately emboldens us to engage in bad fiscal policy. And we're going to pay a price for that. I think that future, particularly if we keep seeing the revisions on our GDP growth, we may have to deal with this much sooner than later.
Well, you should be aware that interest rates are likely to rise and that will raise the interest cost of the debt. That should be part of the calculation that you're making.
Sort of a one-off type question, and you and I touched on this earlier, and you were very kind to engage in the conversation with me. I have an interest in the distortion of the price of money, and more than just what the Fed does in its liquidity and claim on bank reserves and the purchase. It's what we do tax policy-wise on what interest is deductible, what isn't, what is guaranteed. We sat down with some Richmond Fed folks a while back and telling us that the vast majority of total debt, this not including student loan, in this country has full faith or implied credit. Are we in the time of an absolute distortion of the price of money? And does that make your job much more difficult to use money as a communication of activity in the markets?
So it's absolutely true that when, whether it's a student or a business or a household, considers what the relevant cost of borrowing or debt is to them, they look not only at the interest rate they have to pay, but what the other terms are of that borrowing. And if, for example, it's tax advantage, that has an impact on what the relevant cost of money is to them. So, of course, it's true that many things other than just the headline interest rate matters in the incentives facing borrowers.
Well, but my thesis on that is that ultimately hits to your concern of our savings rates. We've created so much distortion over here in the price of money that we've disincentivized proper savings and frugality, particularly in our part as Congress. You've been asked a couple questions, and you've always been very good at bringing up entrepreneurship. One of the things that seems to be working in the economy is some of the alternative access to capital platforms, whether they be crowdsourced lending or crowdsourced equity. much of the regulatory environment is about the systemic risk and a cascade effect to the banking financial systems. But these, when they're crowdsourced, actually have almost no cascade effect. Do you believe the Fed will take a light regulatory touch to sort of the alternative financing models out there that are much more egalitarian, reaching into some of our smaller communities, but actually in many ways are much safer?
So happy to see innovation in the financial sector that makes new forms of financing available. I'm not aware of regulatory issues at this point that affects those vehicles, but I can get back to you if we do have concerns.
Thank you, Madam Chairman. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Thank you, Mr. Chairman. Madam Chairman, I got 5 minutes to try to convince you not to raise interest rates till the spring. Well, I mean, spring is when things naturally are risen. It's when plants come out of the ground. It's a better time than winter and there are some reasons that I think you're already aware of. The IMF study, for example, argues that things should be delayed until early next year. You've got more economic experience than all of us in this room, of course, but on the political side, you should not underestimate the ability of politicians in Europe to screw things up. You should not underestimate the ability of politicians in Washington to screw things up. You need to price in the prospect that we do not pass all the appropriations bills, that we do not raise the debt limit. China, I'm sure you factored in, but it's not just Beijing and Washington that you need to worry about. You need to worry about Norwalk, Connecticut. I mentioned this to you when you were here a few months ago, and I'm hoping that you can get your staff to do a study on this, both for two purposes. One, to let the country know how important this is and what its economic effect will be, and the second, to inform your own decision so that if this prospective terrible decision does occur, you factor in the fact that it's going to shave half a point away from our economic growth at least. I'm referring, of course, as you know, to the argument that we're going to capitalize all leases. This would add $2 trillion to the corporate balance sheets liabilities of America, a $2 trillion increase in liabilities, not because anything's happened in the economy, but just because as a matter of theological, esoteric accounting thinking that I have to confess I actually understand, and no one should, but for no benefit to our economy, we may add $2 trillion. When you do that, you throw all the balance sheet ratios out of whack, you force companies to try to retrench and make their balance sheets look better, and you strongly disincentivize entering into long-term leases. Companies will say, well, gee, yes, you can open that shopping center. Why don't we sign a one-year lease for the anchor store? And, oh, we'll renew it later, but we can't sign more than a one-year lease because our balance sheet will look terrible. So if you factor all those reasons in, maybe that'll push you in the right direction, but there are more. The reason to raise interest rates, the one other that you're already aware of, and that is our unemployment rate doesn't capture all those who have dropped out of the labor market. We have an all-time low labor participation rate. When you adjust for that, the unemployment rate does not justify an increase. The reason given to raise interest rates is to deal with the prospect of inflation. Inflation is already very low. You've got a 2% target, you're not hitting it. You got to keep interest rates low to hit that target, but by the way, that's too low a target. Lawrence Ball and other economists have argued for even a 4% rate. And it's in real business where things stick, where you may have an employee who gets fired who might not get fired if there was an easy way to reduce their cost by 2 or 3%. And then finally, you have all the baby boomer retirees. And I will point, it's not in your mandate, but it is in the Declaration of Independence, a desire for happiness. There are economists and CPAs for whom a 1% real interest rate is always a 1% real interest rate. That's way less than 1% of the people. For everyone else, they live in a nominal world. And if you're a retiree in a zero inflation rate, 1% real interest rate world, you're living on 1% because you psychologically cannot invade principal. If instead you're in a 3% inflation, 4% interest rate, 1% real rate of return world, you are deliriously happy. You are earning 4%, and nominally you are not invading principal. And this works for everybody except economists and CPAs, which means just about everybody. So please, wait till spring.
Time of the gentleman has expired. The chair recognizes now the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman. Thank you, Chair Yellen, for taking the time to be able to be here today. We've heard comments from our colleagues across the aisle in terms of the disparate impact that we're seeing in a failed economy for minority communities, and I'd like to be able to expand that actually for what we're seeing in rural America as well, where the economy simply isn't moving, and one of the key components for that is obviously access to capital for our community banks. You just cited a few moments ago, it's been a difficult period for community banks. Regulatory burdens have been high. And I guess what my question is, this follows up on comments that you'd made earlier in the year, which were then supplemented by FDIC Chairman Sheila Bair as well, that we've got an overzealous regulatory burden which is impacting some of the community banks that are going in. What assurances, what policies are you going to be putting forward? Because it seems to be that through Dodd-Frank, it's a matter of shoot, then aim. And now we're trying to be reactive, but at home, our people are feeling the pain of bad policy that's come out of Dodd-Frank and what we're feeling, and what are you going to be doing at the Fed to be able to alleviate this?
Well, we are very focused on community banks. We want to...
That's what they're worried about, by the way.
We formed a council called CDAC that consists of community bankers, and they come to see us twice a year. The entire board meets with them. There are also, in each of the 12 Federal Reserve districts, versions of on a regional scale of a council to advise the reserve banks on factors affecting community banks. So we are listening. We are taking seriously the complaints that we hear and the specifics about our supervision and trying to be responsive. We've done.
And I appreciate that, but if I can put a little exclamation point on this. Sat down with community banks in my district. They feel that they are no longer working as a banker, but they are working for the federal government. They are working just for to be able to comply with regulations that are currently in place. And while we may have hearings, they don't feel that anyone is actually listening because this is stagnating that growth in those community banks.
Well, we are listening, and we are taking a series of steps that I believe are meaningful to reduce burden, including reducing the amount of time we spend in these banks, disrupting the other activities that they want to be doing by reducing our demands for documentation, taking a more risk-focused approach to reduce the burdens of exams. We're trying to make clear to the community banks what's relevant to them, and so many of the regulations under Dodd-Frank we've put in effect only affect larger banks, and particularly the most systemically important banks.
But you do recognize that a lot of our community banks de facto feel they still have to be able to comply with those Dodd-Frank regulations, even though you're saying we're going to look the other way. It doesn't really apply to you. They're still feeling the impacts that are coming out of Dodd-Frank.
Well, there are some things that Dodd-Frank imposed on all firms. For example, the Volcker rule could envision their community banks being exempt from Volcker. Now, we're trying to tailor our implementation of Volcker to utterly minimize the burden on community banks, but they are subject to it. There might be some steps that
We just
could be
introduced
taken
legislation for tailoring bank regulations. We have 55 different banking organizations that have endorsed the legislation. We hope you will too, because we've got to be able to get the economies moving in rural America and our minority communities, because when we're looking at that 5.3 and we're talking about, as Mr. Rothfuss had pointed out, a real unemployment level that's 10.5%, is part of the problem when you aren't raising interest rates right now. Is what you're really saying is our economy stinks right now. We're just not seeing real movement and what tools do you have left in the toolbox to be able to stimulate this?
Well, I would say we've gotten our economy is in a much better state. Low interest rates have facilitated it, and a decision on our part to raise rates will say, no, the economy doesn't stink, we're close to where we want to be, and we now think the economy can not only tolerate but needs higher rates. So there have been headwinds, and we've tried to use monetary policy to overcome them. But I want you to know that we share the goal of minimizing burden on community banks, and will remain very focused on it. We have the Agrippa process that is in play at the moment, and it is focusing particularly on burdens in community banks.
Time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Chair, and also thank you, Chairwoman Yellen, for being here. Is it regulation from Dodd-Frank that's keeping our economy in a, for the people who haven't been able to benefit from the economy and the recovery? Is it regulation that's causing the problem?
Well, to my mind, there has been an increase in regulatory burden on banks. What we're doing is trying to create a healthier, safer, sounder financial system that will keep credit, flowing to the economy, and particularly if we ever experience a stress situation where, in this financial crisis, we saw banks just withdraw credit for the economy, which took a huge toll on economic activity. By having more capital and liquidity and a safer and sounder financial system, we hope that we are preventing future episodes like the devastating one that we just lived in. And if there is some burden that's associated with that and some costs, the benefit is a far reduced chance of a financial crisis that will take the kind of toll you've just described.
Thank you. So it's been pointed out that we have a low labor participation rate. Is it because of Dodd-Frank?
No. And also we're going to have over time a declining labor force participation rate, first and foremost because we have an aging population, more individuals in the retirement years. This is going to continue. Now, I've said, and my colleagues have, that over and above that, we think there's something holding labor force participation back that reflects weakness in the economy, and that as things strengthen, we would expect some people who've been too discouraged to look for work to move back into employment. But the major reason that we're seeing a trend downward in labor force participation is because of demographics, and it will continue.
Has the CFPB been harmful to the U.S. economy in the recovery?
Well, I mean, Congress created the CFPB to enhance consumer protection, and they've been very focused on doing that.
Well, I just asked because some of my good friends, they complain about it a lot, and I just trying to get an expert opinion on whether it's a good thing or a bad thing for our economy.
So it is addressing potential consumer abuses and trying to enhance consumer protection.
Does that help, does addressing consumer issues like, say, the problems that, the mortgage issues that we saw in the 2008 period and before that, does that help the overall economy? Does that strengthen, does that help markets operate more accurately? Does it help employment?
Well, we certainly saw that the subprime crisis, where there was irresponsible lending, had a very harmful effect on the economy and on low-income communities, and that burden continues to exist. So we're going through a period in which we're trying to address all of the issues, including improper securitization and mortgage underwriting practices that led to that devastating experience. It's difficult to get the balance right and to figure out what the best way is to design regulations. There are always consequences in terms of, unintended effects of regulation. We need to be vigilant about trying to address that.
What about student debt? You know how big it is. Is it a drag on the overall functioning of the economy?
Well, it's increased enormously. I am worried about the high levels of student debt, and it's debt that if an individual can't repay, it never goes away. It can't be written off in bankruptcy. But on the other hand, education is really critical to succeeding in this economy, and it's critically important to make sure that students have access to quality education so they can get ahead. They need good information about programs and their success rates in order to avoid mistakes.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman, and thank you for being here today. I'm a small business owner from Texas. I'm a Main Street guy. I'm a car dealer, one of your favorites. And I can tell you, small business is hurting. Main Street America is hurting, and it's hurting because regulations, which you have talked about today, are literally choking the heart out of small business. And I think, too, that we talked earlier about inequalities. And I would say that competition is the key. Competition in business takes care of inequalities, not the federal government. And my colleague here just was asking for an expert opinion on whether Dodd-Frank and CFPB are good for the economy. I can tell you as an expert opinion, they're bad for the economy, the worst. Now, with that being said, in 2014, in comments before the Joint Economic Committee, and I'll be somewhat repetition here, but I think it's important that we remind you where we need to head our economy, that you stated in questioning from Senator Coates, I quote, "My own discussions with businesses, I hear exactly the same things that you are citing. Concerns with regulations, about taxation, about uncertainty, about fiscal policy. You went on to say there is more work to do to put fiscal policy on a sustainable course. That progress has been made over the last several years in bringing down deficits in the short term, but that a combination of demographics, the structure of entitlement programs, and historic trends in health care costs, we can see that over the long term, deficits will rise to unsustainable levels relative to the economy." Now, my constituents back home in Texas are very concerned about the health of our economy because it is not good. And in Texas, we got great things going, but it still can be better. In Texas, a state that has somewhat recovered since 2008, you have 115 fewer community banks, you have 105 fewer credit unions, tons of consolidation, and a lot of uncertainty about where the economy is headed. So my question, Chair Yellen, what do you say to those community-based institutions that former FDIC Chair Bernanke characterized as saying we're being penalized, and you touched on this today, by your policies, particularly when these policies have at the same time failed to produce meaningful economic growth in the communities those institutions serve, which further erodes their profitability?
Well, what I've said is we're trying to do everything we possibly can to relieve burdens on community banks. They've been through very difficult times. First of all, a period that's been very rough for the economy and a slow recovery, and that's taken a toll on their profitability and that of the businesses, as you noted. And in a low interest rate environment, net margins tend to be low. Now, I think that the low interest rate environment we've had and accommodative monetary policies have served to help our economy overall and get it moving and moving back to full employment. If you compare the United States with any number of other economies that also suffered in the aftermath of the crisis, we're among the leaders in terms of how we're doing economically, and other countries are now pursuing the same kinds of monetary policies that we put into place earlier, which in a way is an endorsement of their effectiveness.
Well, it still is very hard to borrow money for small businesses, and I can tell you banks, as you've probably heard this too, are having to hire more compliance officers than there are loan officers. That takes money out of the system that could be loaned to people like me to hire people and create jobs. And, you know, we had Cordray here before us, and I asked him if he would slow down this Dodd-Frank legislation, because a lot of it is not completed, and because we're losing so many banks and credit unions. And he said, no, we're going to go 100%, we're going to take a look at it. That is a bad policy. Now, you stated that the community banks shouldn't face the same scrutiny as bigger banks. You said that today, and I agree, and that the Fed will tailor its supervision to reduce regulatory burden. I heard you say in 2014, I heard you say that you said I had community bankers in my, or just yesterday, from what you said, and I heard today from community bankers asking me, what do I do? We say the right thing, but what do we do? They're fearful of things that can happen, of what they may not do. So they don't know what to do. What would you tell these people? I mean, we talk a good game, but we don't come through.
Well, we're trying to make clear our supervisory expectations and work carefully with them to know what rules and regulations apply and how, and what don't, and to try to shield them from many of the things that larger banks have to.
Well, it's very vague, and I hope you'll understand. Mr. Chairman, I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chair, and thank you, Chair Yellen, for being here. Appreciate it very much. You know, everybody wants the same thing. We want more jobs. We want higher paying jobs. I'm a business owner like Mr. Williams and other folks in this room, and I love talking with other business owners because they grow our economy and create opportunities for our kids. Now, if you're in my district and you're talking to the owners of a paper mill or a convenience store, they say the same thing, that they are spending so much time and so much money to comply with government regulations that they can't afford to grow their businesses and hire more workers. Now, the Competitive Enterprise Institute calculates that the cost of businesses in America in 1 year to comply with just federal government regulations is $1.9 trillion. $1.9 trillion. Now, these businesses pass on the cost of these regulations in the price of their products. So our families are spending about $15,000 a year for businesses to comply with government regulations. Now, I'm sure we can agree, Ms. Chair, that businesses need to be fairly regulated and predictably regulated, but when those regulations are killing jobs, it's just not right. Now, several years ago, with a highly partisan vote with very little Republican support, the 2,300-page Dodd-Frank bill was passed. And since then, there have been mountains and mountains of regulations and rules that are starting to smother our financial services industry. And one part of Dodd-Frank that's a great concern of mine is the too big to fail regulations, the SIFI designation. Now, when FSOC is trying to identify what banks and other non-financial institutions like asset managers should be designated as too big to fail, it means that the taxpayers, if they fail, will have to step in and bail them out. Now, we all know that there's a huge difference, Chair Yellen, between large money-centered banks with all kinds of tentacles running through our economy and asset managers, mutual funds, pension fund managers, that handle the retirement savings for millions of Americans with no systemic risk to the economy. Now, the former director of the nonpartisan Congressional Budget Office calculates that if asset managers have to comply with these too-big-to-fail regulations with no systemic risk imposed to the market, it'll drive up the cost of their operations to the extent where the long-term rates of return that they can generate for millions of Americans in this country who are saving for their retirements will be dinged by about 25%. I don't know about you, but where I come from, 25% is a lot of money. Can't we agree, Chair Yellen, right now, that it just doesn't make any sense for non-bank financial institutions that pose no systemic risk to the market, like asset managers, they should escape this Dodd-Frank regulation that penalizes our savers?
Well, the FSOC is charged with attempting to identify threats to the financial stability of our country, and they issued a public notice indicating what they're going to do is to look at particular activities.
Okay, so they're still looking at
not firms, but asset management activities that could pose risks.
Okay,
so
well, I appreciate that. So you're still looking
the focus.
at it. You're still looking at it. Okay, I'd like to switch gears if I can in my remaining minute. You've stated on a number of occasions that you're very concerned about unsustainable deficit spending in this country, how it might impact economic growth and job creation, and I agree. Now, everybody knows that's run a family budget or a small business that you can't spend more than you take in for long periods of time, borrow to make up the difference without getting into trouble. But that's exactly what Congress has done, and that's why we have an $18 trillion national debt. Now, we have some folks that come, Ms. Yellen, before our committee, including Secretary of the Treasury, Mr. Liu, who was here a few weeks ago, said, you know, a $500 billion annual deficit, it's no big deal because it's only 3% of our GDP. I disagree with that, and I bet you do too. I was a state treasurer in Maine, and I can tell you that high levels of public debt caused by long periods of deficit spending can do great damage to our economy because we need to pay the interest on that rising debt. Therefore, we're not able to spend it to build roads and bridges and educate our kids. This year, Chair Yellen, this year, we're spending about $230 billion interest payments on that debt. And in 10 years, it's projected to be $800 billion more than we pay to defend our country. Can't we agree that it's about time you help us and Congress gets its act together when it comes to reducing our deficit spending and our debt?
Well, I did indicate my concern with the sustainability of the debt path that the United States is on.
And I hope you use your influence in this town, Chair Yellen, to make sure you talk with the other folks in the administration to make sure they
Time of the gentleman has expired.
Thank you, sir.
The chair wishes to inform the remaining members that the chair anticipates clearing 2 more members in the queue, the gentleman from Arkansas, Mr. Hill, and the gentleman from Oklahoma, Mr. Lucas. At that point, I anticipate adjourning the hearing. Gentleman from Arkansas, Mr. Hill is recognized.
Thank you, Chairman. Chair Yellen, thanks for being here today very much. A couple of items I wanted to bring. Mr. Heck talked about banking availability, and in the Harvard study that everyone's read the last few months, you see that 1 out of 5 counties, particularly rural counties, now no longer have a physical presence of a bank. So not a branch of a national bank, but not even a presence of a commercial bank. I think that's concerning. It speaks to his point. And 2 things on that item I want to call to your attention that relates to merger approval issues at the Fed. One is the Herfindahl Index. I think the Herfindahl Index, which was adopted back in the 60s as bank mergers became subject to the antitrust rules, discriminate against rural areas. I think the idea of using county designations and using deposits as the sole member of indicia for what business is a trade area is incorrect. And I can give you many examples of this, but I would invite the board staff to reconsider how to do bank mergers, not base them on deposits only, not base them on the Herfindahl Index, particularly in rural counties. Secondly is the issue of comment letters on mergers. Mergers for between bank holding companies, if there's no comment, you have a 56-day approval process. If they get one comment letter, that extends to 206 days for approval, which reduces efficiency, reduces productivity of that. And I'd like to see the board adopt a new approach on comment letters and distinguish between real comment letters from the geographies connected to the merger and just promotional fishing expedition comment letters, and let the reserve banks have more power and not force a Board of Governors approval of mergers. I'm going to write you about this. You don't need to comment on it today. I would like you to comment on labor force participation rate, because my reading of the cohorts that you referenced a minute ago actually is that younger people are who have dropped out of the labor force. In fact, people over 55 are working more than ever before. And I really take issue with your point that it's those of us in the baby boom generation retiring. I think if you go back and look at those numbers, you'll find that it's actually younger people being forced out of the, or not having the opportunity to participate in the labor force.
So I agree with you that younger cohorts of retirees are working more than their parents and grandparents did. That's absolutely true. It's just that there is such a substantial drop-off in labor force participation when people retire that when you look at the joint effect of an aging population, more people in age brackets where they do retire, that the working more is only an offset. It's not the same order of magnitude as the demographic effect of the aging. I don't disagree with what you've said about that.
Let me change subjects and go back to liquidity. Secretary Lew, when he was here, talked about the factors, including technology, regulation, and competition, that are reducing liquidity in the markets in his testimony. He said the business models and risk appetite of traditional broker-dealers have changed, with some broker-dealers reducing their securities inventories and in certain cases exiting certain markets. And notwithstanding the October study, Chairman Luca Nagelbauer also had a roundtable last week in which a participant from the market, J.P. Morgan, I believe, stated that in the Treasury market, it used to, you could be able to do a $500 million trade and not have a bid-ask spread move. The market would not move. Now, her estimate was it's down to $192 million. So there's some indication of, even in the Treasury, the most liquid market, we have significantly reduced liquidity. And in the FSOC report on page 68, the primary dealer securities holdings shows since the crash and since the implementation of Dodd-Frank, Treasury holdings, of course, have gone up to high levels, and all other categories, corporates and even agency securities, have dropped, which implies to me that people are holding Treasuries, holding liquidity, and not making a market in that. And I really think regulation is being shortchanged here and its impact. And I'd like you to comment on Basel, the liquidity rules, all working together that are causing a lack of liquidity.
I'm not ruling out the possibility that regulations could play a role here. It's simply we've not been able to understand there are a lot of different factors, and we need to look at it more to sort out just what's going on and what the different influences are. I'm not ruling that out.
Thank you.
Chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman, and I appreciate your indulgence at the end of the hearing. And Chair, I'll try to move in an expeditious sort of a fashion. First, an observation. As you and I have discussed before, my part of the country is very economically dependent on the oil and gas industry. And I'm hearing concerns from those who are involved in energy lending about regulatory pressure on the treatment of energy loans, reserve-based loans, crude oil in the ground, proven reserves during this current period of low prices. I'm concerned if banks have less flexibility in dealing with lending to these companies in this sector, that an accumulative impact of all the factors as we move towards the end of the year could result in loans potentially being defaulted on or bankruptcy filings. It would be devastatingly destructive to the domestic energy industry. So I just ask that we be understanding of the nature of those proven barrels in the ground. Second question. or second observation of the question. The last time we were together before this committee, we discussed the Basel III leverage ratio rule as it relates to the treatment of segregated margin. And I appreciated your response in addressing the matter of on-balance sheet accounting treatment. But I'd like to go just a little further today and specifically talk about the Basel leverage ratio now extending to off-balance sheet exposures that are not driven by accounting rules. And in this off-balance sheet context, why is customer margin collected by a bank-affiliated member of a clearinghouse being treated as something the bank can leverage when Congress very explicitly required that such margin be segregated away from the bank's own resources? And for the benefit of my colleagues, I suspect on any given day, we're actually probably talking a couple of 200 million, oh, we use big numbers here, $200 billion in resources on any given day. Could you enlighten us a little bit on that, Chair, please?
Well, the leverage ratio is meant to be a very simple, non-risk-based measure that pertains to all assets that are carried on a bank's balance sheet, and that includes derivative transactions. It's not clear that for many companies the leverage ratio is what's binding, rather risk-based capital standards in many cases. But this is something we're having a look at. I recognize it's a concern. It's something that the Basel Committee is discussing and trying to gather additional information on what impact it's having. And it is something that is very useful to put on the agenda that we will have a close look at.
And that's all I can ask, Chair, that you work with our friends at the CFTC here and our foreign regulator friends to come up with a sensible approach. $200 billion that can't be touched by the banks, but yet they have to have extra resources to cover. Just seems like the net effect would be more cost and more strain on those trying to use these resources. So I appreciate your comments. And with that, Mr. Chairman, out of character, I yield back.
Gentleman yields back. Chair Yellen, I want to thank you for your testimony today before the committee. Pursuant to our earlier discussion, we look forward to having you back soon, separate and apart from your Humphrey Hawkins appearances. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I would ask that the chair please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.